Good morning, everyone, and welcome to our September 2021 Left 2 board meeting. I'll go ahead and call our meeting to order. And let's go ahead and start off with a moment of silence to remember our fallen brothers and sisters, as well as our military personnel since our last meeting. All right, thank you. By looking at our agenda, we do have a very full agenda today. We've got a lot of people online. We thank them for being here with us. From our first action item, looks like approval of our minutes. This would be from our July meeting. I would entertain a motion to approve as presented.
So moved.
Motion's been made. Is there a second?
Second.
Motion made and seconded. Any discussion, corrections, comments regarding our minutes? Seeing or hearing none. All those, Steve, are we okay with just doing a roll on this one, or not a roll call, just a simple?
Yes, you have a quorum, so a voice vote is would be okay as long as it's unanimous.
All right. All those in favor of adopting the minutes, please say yes or aye.
Aye.
Aye. Yes.
Opposed? All right, the minutes are adopted. Thank you very much. Number 2 item is the Department of Retirement System benchmarking. And Steve, by introduction, you want to go ahead and introduce Mark?
Yes. Annually, the Department of Retirement Systems reports to the board about the administration of benefits. Particularly, this presentation deals with the cost effectiveness of DRS administration, and there'll be a presentation by Director Garin later in the interim. With that, Mark Feldhausen coordinates the administration, the DRS benchmarking for the department, and Mike Healy is here from CEM benchmarking. With that, I will turn it over to Mark for any further introductions and the presentation.
Okay. Thank you, Steve. Members of the board, thank you for inviting me back, actually inviting us back. I'm glad that I was able to get Mike to zoom in and help me co-present. We've been working on this for quite some time, been benchmarking. We get a lot of valuable information through our participation in this. And it's really a great opportunity for us to learn more about our business and how others actually around the world are doing it. So with that, go ahead and go to the first slide, please.
Thanks, Mark, and it's Mike Heel from CEM, and it's good to be with you. We're going to be talking about your costs and service levels, and we're going to be comparing you to other retirement systems. This slide shows the demographic sketch of the participants in our pension administration benchmarking service from around the world. About 2/3 of them are from North America, and the rest are mainly from Europe. The benefit of having sort of global participation in the service is you can get best practice ideas that you might want to emulate and borrow from anywhere in the world, and networking and sharing best practice ideas is a part of the service. But in terms of comparing your operating results, costs, and service levels, it makes most sense to compare you to a peer group of systems that are most comparable to yourself. And on the next slide, Mark is going to speak to the large US systems that are in your peer group.
Yeah, the US map that I have here that does not include Alaska or Hawaii, they have not participated in the service for benchmarking, and they wouldn't have a system actually large enough to be in our peer group. We've worked with CEM over the years to try to decide, kind of where to draw that line. And in the most recent data, it was at 300,000 active members and annuitants. And what we're trying to do there is maintain a large enough peer group for all the statistical analysis that is done, and also to make sure that it's a meaningful peer group. And even though it does isolate us to that peer group, and you'll see this in some of the later charts where it distinguishes, our data point from the data points of the peers, and then the data points of all the other systems from North America, including the Canadian systems, you get to see that comparison. But as Mike identified, even with the international participants, there's a lot of really good ideas that can be generated on how to deal with any of the kind of the customer issues or any of the regulation changes, maybe demographic changes as well. So we do get a really good statistical mix for the analysis that is done. And there's only a few peers. In fact, there's only a couple of them that actually would be larger than DRS that weren't in the most recent extract of data for fiscal year 20. So it is really good for all the analytics that come out of it. So next slide, please.
I'm going to talk a little bit about complexity here, but first I'll point out that in this slide and the next series of similar slides, your data point is the very dark blue bar. The medium shade blue bars are the peer group of large US funds that Mark talked about. And the lighter blue shade are all the rest of the systems in North America, smaller US systems and the Canadian systems. So here we're looking at your complexity. You have the 5th highest complexity score at 51 of the North American plans that we study. And complexity is a composite measure that takes into account the number of plans you have on your platform, the different plan types you have on your platform, and whether or not you have multiple rule sets and formulas that you need to take into consideration when calculating benefits and interacting with your members. And you do indeed have what we refer to as an umbrella administrator. So you have higher complexity, more rule sets, more formulas that your IT systems and your customer service staff have to deal with. We don't model this directly in the cost analysis that we do, but there's no doubt that it does have an impact and creates additional challenges for you. The next slide moves us on to take a look at your costs. And you can see in the shout out box, it shows your cost per member. And we do look at members drive costs. And we look at active members and annuitants because by far they are the biggest drivers of cost. Deferred or inactive members generally don't generate much work. So the common denominator for comparing costs for everyone is per active member and annuitant. Your cost of $73.55 was below the peer median of $80. It was $21 below the peer average and about $45 below the all North American average. So you are a low cost system. If you look at the inserted chart shown on the slide, you can see, and you're the bottom dark blue bar there compared to the peer average and the all average, you can see that you have consistently been well below peer average costs historically. But that has narrowed somewhat in the last couple of years. And from 2019 fiscal year to 2020 fiscal year, your costs did increase by $11 per member. This, however, can be attributed to major projects and your system renewal work being the major part of that. And Mark on the next couple of slides is going to talk about reasons for your cost status and the impact of major projects.
Yeah, this mixed column and line chart here, I put this together to show the impact of the major projects on our total cost per member. And I went back and pulled data going back to 2015 to show what I refer to as our base costs, which would be all of the administrative costs with the exception of the major projects. And then I stacked the amount that was due to major projects on top of that in the little orange stack. And what this shows is that our cost for base services has pretty much stayed below $60 per member for all the years. but you do see how much of an impact the major projects that we had last fiscal year, how much it changed our relation to the peer median and the peer average. So you see us basically, having a good amount there added on. And Mike mentioned, part of it was our mainframe rehosting project, basically taking our historical legacy systems and moving them off the mainframe. And that's an ongoing project. We have additional components to that will start coming into the benchmarking. We also were transitioning to a new record keeper and renovating our office building. So the aggregation of those three one-time costs were the cause of the increase that got us a little bit closer to the peer group. Next slide, please. Okay, this takes a couple of the, CEM over the years has tried to explain, what is the major cost driver that explains why, maybe Oregon PERS has one value of cost per member, and Washington State DRS has a different one, and PERS Idaho has a different one, and Missouri retirement systems. It's like, why do they have different costs? And in looking at that, it's one of the things I've really admired. Of course, I'm kind of a statistics guy, and to see the research done by CEM with all the participants to look at different hypotheses, if you will. Is it complexity? Is it the cost environment that you're in? It's going to be more costly to have your headquarters in Manhattan than it is in Tumwater. Is it the service levels? If you're providing a tremendously high level of service, is that what is driving cost? And none of those purely will line up to be a nice, linear relationship as far as if you're higher here, you're going to be higher cost, or if you're lower, you're going to be lower cost. None of those have a direct relationship. So they continue to maintain a lot of level of detail and information within the analysis, and they do look for, okay, well, how could we explain why you are different in cost? What does the data point to? And in the case of DRS, Mike mentioned that we were $21 lower than the peer average in total cost per member. And the two indicators that could help explain that 21, the highest one was we actually have 31% fewer front office FTEs per member than the peer average. So we have a low number of FTEs, and FTEs can be a large driver of cost for a pension administrator. And then in addition to that, our FTEs actually cost less. So they cost less, 12% below the peer average, per FTE. And that's a composite of their salaries, benefits, the building costs of having them be in the office building, the HR costs, and then the IT and desktop. So how much does it cost to actually put a system on their desk, hire them, put them in a building, and then pay them? Our cost there is 12% less. The combination of those two explain 19 of the $21 are being lower than the peer average.
Dennis, this is McElligott.
Yes.
Mark and Mike, and a lot of other funds, Washington State's DRS just deals with the administration of retirements, where a lot of the other funds also have investment vehicles. That's all backed out, correct?
Correct.
Okay, thank you.
Yeah, the kind of the rigor of the survey, one of the primary things in that is to make sure that they get it as close to apples as they can. Otherwise, the resulting analysis is meaningless. So it's very clear there. Pension administration is isolated from investment management. It's also isolated from any kind of discretionary or one-off programs that wouldn't be consistent. They really want it to be comparable. Okay, next slide, please.
Here we start to look at service level, and it's showing your composite score of 73, which is a little bit below the peer median of 76. We measure service from a member's perspective and what they would consider good service. And so it's things like your turnaround times. It's things like choice of channel for getting the service, more availability of service, better content. It's an omnibus score that cuts across 14 activities that touch your members and over 100 separate measures. You're a little bit below the peer median in 2019. Historically, you've been around peer median or slightly above, and your service levels have taken a little bit of a dip. And a big part of that, as we'll see when we talk about the next slide, is the some call center issues that you've had over the last couple of years. As part of the service, we itemize what it would take for DRS to move its score to the highest possible. And it's not that we're recommending that you do that. You're running a business, and you have to make decisions about what's the optimal level of service and the optimal level of costs you want to bear, because there can be trade-offs certainly in some areas, and call centers, I suppose, is one of them. But here are sort of the top areas that, if you chose to improve service, would be in the call center area. And they combine to about 9 additional points across getting your call answer time down to 60 seconds, reducing your abandoned calls rate, and doing coaching or reviewing of more incoming calls to improve the quality that your customer service reps are delivering. And if we hit advance, there's some additional information on this slide. You'll see that this is the potential service improvement. If you were to address all 3 of these issues, you would move to well above median. And again, we're not recommending these, but the report does have a lot of detail about service improvement opportunities that you may choose to undertake.
Yeah, and part of the items that we bring into the analysis of whether or not we do pursue any of these is through discussions like this and other discussions with our authorizing environments. What do they recommend that we pursue? And what do our customers want from us and expect from us? So those need to be brought into the equation as well as the total cost, because some of these items, I only mentioned the top 3, but there's numerous pages that go through incrementally, everything that we could do. And some of them could be to, expand our call center to have it basically have people in the building answering the phones on Saturdays, having one-on-one counseling, basically having satellite offices. So there are some what would be kind of high cost items that would bump up the score. So it's really been nice to have that recognition by CEM, not to or to warn people, don't chase your service score. Listen to your customers, listen to your authorizing environment. What do they want, and what is cost effective for you to do? Okay, next slide, please. This slide takes and puts a couple of graphs together. The top one looks at our total pension IT, or our IS cost per active member and annuitant, showing that we're just a little bit below the peer median. Part of this is, kind of where you're at in your investment cycle relative to your systems. And where we're at is we're basically starting to invest in replacing and modernizing our systems. Also, one of the components that would have come into play in the most recent year would have been some additional costs that we put into information technology security to increase the security of our systems because of all the data that we do house and protect on behalf of our members. The lower one looks at the item that I talked a little bit about earlier, just to show you where we line up as far as our total major project cost per active member and annuitant, and where that was relative to what our peers and the other participants reported for that year. You can see that we are clearly above the median and close down to the far right side of the chart. Back a slide, maybe.
Sorry, I'll have that back up in a moment, sorry.
Oh, yeah, that's okay. You're just trying to rush me, trying to get me done real quick. There, Tim.
I say, if there was a queue, that was one.
Yeah.
Back on the slide, you want the IT and projects, or do you want the last slide?
Yeah, go ahead and move it on to the final slide. This is the one where the primary question, or the most consistent question I've got over the years in doing this presentation to the various audiences is essentially, well, why do you guys do this? And it really does get at, I borrowed some information here from one of CEM's pages on their website, where they talk about, essentially why they are in this area of business, this line of business. And those of us that participate both nationally and internationally, a lot of it is to get at the measures to our peers, other people that are doing the same thing we're doing, facing the same challenges that we face, getting those really detailed comparisons, being able to learn from our peers, and then get those insights as far as not just learning from your peers, but getting those pieces of information relative to, well, if I pursue that, and this is one of the things from looking at past surveys where they get at like different applications that you could put out there for self-service. And there's data on uptake. Well, how many of your members might use that? So that you also get information on potentially how much it might cost to put that in place. And it helps you with that cost benefit analysis as far as, I could put that thing in that maybe Ontario Teachers has in their system, but, oh boy, low uptake, high cost, I'm really not going to go down that path. So there is a lot of very interesting information in this, and we put a lot of value in the data that we get out of it. So any other closing comments, Mike?
No, that's great. Thank you. Thank you, Mark. Are there any questions from our audience?
Mark, I had a question texted in. Would it be, you guys spoke briefly about the call center customer service. Would it be possible to get information on the other customer service measures and where they sit?
Sure.
Thank you.
Yeah, there's several underlying measures that in addition to those that go into the call center score that Mark has available for you.
All right, I have a question for you. Can you hear me okay?
Yes.
How has COVID played into this at all with our inability to actually have meetings in Olympia or Tumwater? Has this affected our scores?
Well, it's affected everybody to a certain extent, obviously. In this report for you, there was 3 months of COVID experience, the start of the COVID experience effectively reflected in your scores. That was true of half your peers, but not the other half. So at the margin, you were impacted more by the COVID experience in this year's scores than others. And the first part of the COVID experience, the adjustment part, was the most, at least anecdotally, we don't have data to support this, but anecdotally, and what our clients have told us, was the most challenging and where the most problems and service interruptions were experienced. And after that, most systems have reported to us that it settled in quite nicely and worked quite well.
And then I also noticed, I think the peer average score was 76. We were 73. Is that correct?
In this report, yes,
Yeah.
And that is a bit of a drop for you. You were at peer median the year before, and historically you've tended to be around peer median or slightly above in terms of service.
Okay. All right. Thank you. Any other questions for the group? All right. Thank you very much. I appreciate it.
Thank you very much.
Thank you.
Pleasure.
Steve, number 3 on our list is the report on financial condition. Looks like OSA, and it's Matt Smith.
Yes. Every 2 years or periodically, the Office of the State Actuary does a report on financial conditions, and then potentially also recommends new or changes to long-term economic assumptions. Actually, Mitch is going to be doing the report on the financial conditions, and then Matt will be talking about recommendations on long-term economic assumptions immediately following Mitch's presentation. So with that, I will turn it over to Mitch for the report.
Mitch, I've turned over control to you, so.
Okay, thank you, Tim. Good morning, Mr. Chair, members of the board. For the record, Mitch DeCamp, Office of the State Actuary. Definitely not Matt Smith, but I'm going to do my best here today. So this is the first of your 2 actuarial presentations. As Steve said, I'm going to cover the report on financial condition. I get to share a bunch of good news today, so it's actually a really fun presentation for me. And then I'll hand it off to Matt, and he will cover those economic assumptions and the new recommendations. So these presentations are linked. The report on financial condition is really meant to offer context to these new economic assumptions. So for my presentation today, I am going to cover highlights of the report on financial condition. You'll see that often abbreviated as RFC. I'm going to kind of refer to it as RFC throughout the rest of the presentation. That was published jointly with the Economic Experience Study, and I have left a link to both the full reports in the appendix. The other thing I'm going to touch on in my presentation is impacts from the fiscal year 2021 investment return. The report on financial condition, it was completed before these fiscal year 21 investment returns were finalized, so the impacts from them are not included in the report, but they also had a really big impact on the system, so they really fit with what we're talking about here today, and that's the financial condition of the system. So we want to make sure we cover those today as well. And then last thing, no board action required today, just an informational only presentation. Now, before we just jump right into it, the RFC, it really looks at all the retirement systems. So that's what I'm generally going to be speaking towards, but I do have some left to specific slides and commentary. So there's no one measure for assessing plan risk, and the RFC relies on this framework here, and that is what is the health of the retirement plans today? What's it expected to be in the future? How can that future look different? And then risk factors that can be managed. I'm not going to go into a ton of detail on each of these, but I'm really going to hit on the big highlights from the report. So some measures for assessing plan health. How do we look at plan health? Well, we typically look at it through affordability and solvency. Affordability, that's the ability to provide adequate funding. Essentially, how affordable are contribution rates? So for that, we look at contribution rate level and then pensions as a portion of state budget. The other measure is solvency, and that's the ability of the plan to pay for member benefits. Essentially, is the plan getting enough funding to remain solvent? And for that, we typically look at funded ratio. And then I really like this little graphic down here in the bottom right here. We got this guy sort of balancing the solvency of the plan on one end and the affordability of the plan on the other end. And that's really what we're doing with pension funding. We're always trying to balance solvency and affordability. So looking at our first affordability measure, contribution rates, and here we're taking a look at historical contribution rates. So taking a look at the table down here at the bottom of the slide, I have the current adopted contribution rates on the far right side of the table. That is for the 2021-23 biennium, and then the prior 3 collected bienniums. And so what we see, looking at these rates historically, is we see rates, really high rates, increasing rates over this period to some of the highest in plan history, and then the most recent adopted rates show a decrease. And the primary reasons for the decrease, there's a bunch of them, but the big ones are the completed phase-in of the mortality cost. The investment experience has been pretty solid over this period. The Plan 1 UAL rates, those are those additional rates to fund PERS and TERS 1. Those rates have declined to their minimum levels. And then many plans have cut benefits for new hires. And so as more new hires come into the plan, they are less costly than current members. Now, this is where I get to point out left here, we see a bunch of these plans have increasing rates over this period and then decreasing. The left rates are remarkably stable over this period and really speaks to what an excellent job the board has done meeting their goal of stable contribution rates. Now looking at those pension contributions as a portion of state budget, here's where we estimate the portion of the GFS that is going to fund pensions. Far right side of this graph, 6.3% in 2019. Again, that's one of the higher levels we've seen historically. That is projected to then go down with those most recent adopted rates. We don't have those numbers yet because they're currently being collected. And then just what we see historically here, we see how much the portion of GFS has changed over this period. You know, the part that sticks out is sort of the middle 2000s there, 0.5% of GFS. You'll hear people refer to that as the Happy Valley. Out of that period, actually came a lot of pension changes to avoid these low levels of funding in the future. And I'm going to talk about some more of those pension changes in a future slide. So now switching over to solvency. For solvency, we rely on the funded ratio. Quick review on funded ratio. I know it's everybody's favorite measure. It is a comparison of plan assets to the member's earned benefit. So it's like a snapshot in time. And if you have a funded ratio of greater than 100%, it means the plan has more assets than earned benefits. One important note about funded ratio is that if a plan has a funded ratio of over 100%, still typically means the plan is going to require ongoing contributions, such as the case with LEF. With LEF 2, the plan has a lot of active members. As active members gain another year of service in the plan, they have more earned benefits, and we need ongoing contributions to fund those benefits. So now on this slide, we're taking a look at some historical funded ratios. I'm comparing 2014 funded ratio in orange to 2019 funded ratio in the blue bars. We're using 2014 here because that is the earliest year which we switched our actuarial cost method to the one we currently use to determine funded ratio. This makes sure we're really looking at an apples to apples comparison here. So what we see over this period, we see generally increasing funded ratios. The bottom right portion of the slide, you see the bars in total. That's across all retirement plans. In total, 92% as of 2019. That's higher than 2014. And then the other big note here, in 2019, all open plans had a funded ratio of at least 90%, which is pretty good. We do see some pretty varied impacts by system here. The systems all experienced different things over this period. Some had changes to assumptions, general plan experience was different, and then some even had some benefit improvements. All of those combined have varying impacts on the funded ratio. So that's all historical information. What does the future of plan health look like? Well, to kind of start that conversation, we looked at our expected case. And our expected case is assuming all future experience matches our assumptions over the long term. And that's a really big assumption. I can guarantee you the future is not going to exactly match our assumptions, but this expected case gives us an idea of kind of where the plans are trending. So when we look at this expected case, we see continued improvement in both the affordability and solvency metrics. For affordability, we see that percentage of the general fund budget that's going to pensions. We see that declining from 6.4% in 2020 to 3.3% in 2028. so almost cut in half. And then all plans are on target to reach full funding over this period as well. Open plans having a funded ratio of at least 95% by 2023, and then those PERS and TERS 1 UAL rates expected to be paid off by 2027 and 2026 respectively. So a lot of good things on the horizon. But we know the future is not going to equal our expected case. So to get a sense for how the future could look different, we do look at a risk assessment model where we have 2,000 different investment return scenarios. This gives us a really broad look of what the systems could look like under a variety of different investment returns. We do model other plan measures as well, but I'm kind of focusing in on investment returns here because that can have a pretty big impact on plan funding in a relatively short amount of time. We do assess risk under what we've determined current law and past practices. I'm really not going to go into the specifics of those two. I will refer you to the RFC for that. But really what I can share is that affordability and solvency under both metrics have improved since the last report. And if the RFC is just not enough risk talk for you and you just want more, we do have a commentary on risk webpage as well. Provides additional risk analysis and even some sensitivity of financial measures. So simulations aside, we can do all the simulating we want, but nothing is as good as actual experience. And it didn't take long to get some really big, impactful experience. And that's where 2021 comes in. And we had a very different year than expected. The big note on this one is that investment returns for the fiscal year end June 30, 2021 were almost 29%. So a truly huge investment return. To put this in context, it is the highest single year return in over 30 years. To put it in terms of dollars, it was approximately across all retirement systems, they returned approximately $22 billion in additional investment earnings above expected. So really speaks to what an incredible job the State Investment Board has done over the last year investing the assets of the plan and what incredible market performance they've come up with. So the big question when you have a huge return like this is, will any of this be given back through a market downturn? And of course, we don't know the answer to that, but we can look at history to kind of get a sense for what has happened in the past when we've had large investment earnings. So we looked over the past 25 years. We saw 3 years that had investment returns over 20%. We then looked at the next 5 years after those large returns and looked at what the 5-year average return was. So of those 3 years, 2 of the years had a 5-year average lower than the currently assumed return, and 1 of them had a 5-year average right at about the assumed return. So this doesn't exactly mean that investment returns are definitely going to be lower for the next 5 years. Markets are very volatile from year to year, nearly impossible to predict. But history does tell us that the markets typically are a little bit lower after having large gains. So the other thing I'll point out on here before moving on is that 29%, that is the return that WSIB uses to report the return on the commingled trust fund. LEF2 and the other retirement systems use a different measure for their actuarial valuations. They typically come in really close, but when the returns are very large like this, the difference can look a little larger than it does in most years. That sort of standard measure that we would normally use for your actuarial valuation wasn't available for the RFC or for this presentation. So some of the analysis that you are going to see after this slide here is based on that 29%. But know that when you get your actuarial valuation next year from our office, it will have a slightly different return than the 29%. Some preliminary numbers coming in, it looks like it may be around 30 or even 31%. So just means even more good news from 2021. So how do we account for this very large return we have? Well, we account for it by developing an actuarial value of assets, or an AVA. I know this is review for a lot of you, but I think it's really important to look at this again, especially after having a large return like we did in 2021. So we develop an AVA, and we do that by calculating a gain or loss based on the 7.4% expected return. 29% obviously greater than 7.4, so we have an asset gain this year. Then we smooth that gain over a period of up to 8 years. And why do we do this? Well, that smoothing helps to reduce contribution rates and funded status volatility. We've all been living through it. Markets are very, very volatile from year to year, and we want to try to reduce some of that inherent market volatility in our plan measures. Under a reasonable set of assumptions, we do expect that gains and losses will generally offset over the long term. So I do want to show the funding schedule. I don't think I've ever actually brought this table up to the board before. This table shows actually how we smooth based on what the investment return was. So kind of looking in the middle of the table here, you see the 1 year. Let's start there. Going to the column to the left of that, what's that saying is if the actual investment return is between 6.4 and 8.4%, we will smooth for 1 year. So we will essentially no smoothing. We will have an annual, we will recognize all of it right away. Now stepping up a row, if the investment return is between 8.4 and 9.4%, we will smooth for 2 years. So 50% recognition 1 year, 50% recognition the next year. And you can kind of get the trend here. For every 1% that the actual investment return differs from the expected, we add an additional year of smoothing. And so we handle positive asset experience the same as negative asset experience. Same difference, 1% difference from the expected, we add an additional year of smoothing, and then that's capped at 8 years. So 29% puts us firmly in the 8-year smoothing period, so this return will be recognized over an 8-year period. So I want to show kind of what this does to left two's funded ratio. Here I have graphed valuation year by funded ratio, and I'm showing two different projections here, our baseline projection and the 2021 returning path. So under our baseline projection, that's sort of the expected case, where we assume 7.4% for 2021 and every year after. So under the baseline projection, we were projecting left two funded ratio to hover right around 112, 113%, and it was going to remain there pretty steadily. Now 2021 comes along. So we have the really big return in 2021. For this analysis, we're assuming 7.4% each year after. So we see the first difference in 2021 is we recognize part of the asset gain, and then those lines continue to diverge as we keep recognizing more of that asset gain. In this sort of expected analysis, the funded ratio for left we're projecting gets up to 130% by our 2025 valuation. I just will stress here that this is really the expected case, right? 7.4% investment return each year in the future following 2021. We know that's not going to happen, and any sort of market volatility will change these projections. One thing I did want to mention about the asset return as well is that we don't include it in this funded ratio analysis, but the LEP2 benefit improvement account, or the BIA, that is also invested in the commingled trust fund. So the BIA also experienced the large asset gain from 2021. The value of the BIA on June 30th of 2020 was about $340 million. And based on this return, we're estimating it's coming up to about $440 million. So about a $100 million gain for the BIA. So that's how LEF2 handles the return. How about all the other plans? Well, as you might expect, it has It has good impacts on the other plans as well. All open plans expected to have a funded ratio of at least 100% by 2023. Those PERS and TERS 1 UAL rates paid off a couple years earlier, 2025 and 2024 for PERS and TERS respectively. And then in the latest budget, there was an $800 million lump sum payment to be made in 2023 to TERS to help pay down that UAL. If that is paid, the TERS 1 UAL would be paid off in that year as well. So even a year earlier, including that lump sum payment. And I do just want to point out that these projections do not reflect the updated economic assumptions that Matt's going to talk about. So now we've talked about funded ratio. Quick look at what this does to contribution rates. Here I am showing total employer contribution rates. For LEF, that is the combination of the state portion and the local government portion, or the local employer portion. That is also equal to the member rate. So here in this table, we are showing the adopted 21-23 biennium rates on the left, and now this time 3 projected biennia to the right. And what we see here, not surprisingly, we have a very large asset return, so we see decreases in contribution rates. Really the big jump you see for PERS, TERS, SERS, and PSERS happens in the 25-27 biennium, and that's because those PERS and TERS 1 UAL rates are paid off in the prior biennium. Once those plans are paid off, that rate falls away, and what's just left is the normal cost rate for those plans. So pretty big decrease in contribution rates between those 2 biennia. The other thing I'll point out on this slide is you might notice that PERS has a repeat contribution rate for those last 2 biennia, 4.38% in both years. That's actually the place where PERS in this analysis is projected to hit their rate floor. So LEF, you guys, the board are very familiar with rate floors. You guys have been using a high minimum rate for about the last decade to yield stable contribution rates. The other plans have minimum rates as well, but their minimum rates are lower, and it took this large asset return for us to project those minimum rates to finally come into play. So PERS, we're expecting it to hit in the 25-27 biennium, and same with SERS, and the other plans tend to hit in 27-29. So taking a little closer look at LEF here, the 8.53% that is repeated in the first 2 biennia there, that's the rate that the board adopted last year for both of those biennia. You do have the option to revise the 23-25 rates if you so choose. Then looking out to the last 2 biennia in our projection here, we're seeing a decrease, we're projecting a decrease, and that decrease is due to the minimum rates going to 90% of the minimum based on the funding policy that the board adopted 2 years ago. So the big thing here is that the LEF minimum rates do not decrease or do not change with asset returns. That has been a blessing for stable contribution rates, but we also don't see the same decrease in LEF contribution rates as we do with the other plans because they don't adjust with asset returns. I do want to just show you that in a little more detail here. So here we're kind of zooming in on LEF contribution rates. Again, I'm using that baseline projection and that 2021 return impact. Really focusing in on the 2025-27 biennium. So looking at the baseline projections, the teal highlighted row that's bolded, that is the rate our model assumes is adopted based on the board funding policy. And that funding policy is to compare rates under your underlying cost method, the aggregate rate, with your minimum rates, and then select the larger of those 2 rates. So under the baseline projection, we have a 4.83% aggregate rate and a 7.74% minimum rate. So our projection model assumed the minimum rate would be adopted under the baseline projection. Now stepping down to the 2021 return impact, we see a 7.74% again. We have a 1.9% aggregate rate here because that aggregate rate does adjust with changes in the assets. So we have the excellent 21 return, and then that aggregate rate decreases, but no change to the minimum rate, still 7.74%. So our projection model assumes that 7.74% is adopted. So really what I'm trying to show you here is that on a projected basis, there's actually no difference in LEF2 contribution rates because that planned minimum is sort of hiding the aggregate rate, sort of hiding the impact of the 2021 return. So back to the RFC here, just a little bit of plan history here. We've been talking a lot about funding policy changes that are now coming back into play. So in that 2000s period where we saw that big decrease in the portion of GFS to funding pensions, we saw a big decline in funded ratio in that period, 131% to 99%. That's for a variety of reasons: funding shortfalls, market downturns, increases in benefits. And out of that came a number of the policies that we're still using and relying on today. Asset smoothing increased to a maximum of 8 years. That's so we don't recognize bad markets too quickly or good markets too quickly. And then those minimum employer and employee rates came in 2006, and the board has used those to great effect to create stable contribution rates. Final portion of the RFC is risk management. How can we control risk? The first and most kind of bedrock piece of it is adopting reasonable assumptions. From that, setting and adopting adequate and timely contribution rates. Next, affordable and sustainable plan designs for the future. And finally, measuring, monitoring, and mitigating risk. We're never going to completely remove risk from pensions, but we can mitigate it as much as we can. So some final concluding remarks here. We see some pretty marked improvements in affordability and solvency from the last report to this report. We see lower contribution rates and increasing funded ratios. And then when we add the 2021 investment returns, these financial outcomes improve significantly. And then finally, just some parting thoughts on managing pension risk, regular monitoring. You guys are doing that, making necessary adjustments, and then taking a long-term view when considering benefit changes and contribution requirements. And with that, that concludes my presentation. I am happy to answer any questions.
Are there any questions for Mitch? Mitch, I got one. Do all the other plans use asset smoothing?
Correct. Yep, all the other plans use that same asset smoothing schedule that I put up there.
Hey, Mitch, looks like we have a question in the chat for you.
Is the percent smoothing a percent of total return or a percent of excess return? It would be a percent of excess return. So it is whatever we expected, and then everything above that would be what is then smoothed.
Any other questions for Mitch?
Mitch, do you smooth all of the gains, or do you only smooth the excess gains?
We only smooth the excess gains. So we would expect, a certain amount we're going to add that to the actuarial value, and then everything above that would be then smoothed over the period consistent with that smoothing schedule.
Thank you.
All right. Thank you, Mitch.
All right. Thank you.
All right, Steve, it looks like Matt's going to come up now.
Good morning, Chair Lawson, members of the board. Great to be with you, even if virtually today. I know it's been a while. Heavy dose of a technical presentation, so drink that coffee or tea, and bear with me.
Matt, you should have control of the screen now.
Thanks, Tim.
Great presentation, Matt. We'll see you next year.
Looks like it's not advancing for me. There we go. All right, so similar to Mitch's presentation, this is we're just covering the highlights of the economic experience study, but I'll have to admit, I mean, you know, we live and breathe this stuff on a daily basis, so trying to water it down, but it's tough. But to the extent that it's practical, I'd love for this to be a conversation. Feel free to interrupt at any point in time. This is for you. I'm trying to explain the work that we did, but I'm also mindful of your role. So I'm required to do this in statute every other year. You know, make these recommendations. I make them to you. I make them to the Pension Funding Council. You can adopt changes at any time to these assumptions. You certainly don't have to do that today. I don't think that's contemplated either. And again, this presentation really trying to assist you in determining whether or not to adopt changes to your economic assumptions. And I hope you find this, I intend to share some considerations, and I hope you'll find them helpful in your role. So starting off with some basics, I think you're all familiar with this, but just to make sure we're on the same page. What economic assumptions are we talking about? Inflation, general salary growth, investment return. And investment return is the biggie. And we're going to spend most of our time talking about that. And you'll see a bit on every one of these assumptions, but yeah, most of it's going to be on investment return because it is so impactful. It's always important to consider the purpose of these assumptions. How are they going to be used? What's the context, right? These assumptions are used to measure pension obligations and determine contribution rates. Put another way, these are assumptions for an actuarial funding valuation, right? Ongoing plan. If we were doing accounting, it's different. If you're asking me to do one valuation and shut down the plan and settle it with an insurance company, we'd use different assumptions. There are no prescribed assumptions for financial reporting, by the way. We use OSA's best estimate assumptions when we do financial reporting. But yet today we're talking about funding, so you want to keep that in mind. Long-term assumptions. So what do I mean by that? And I think this is an important point to clarify. So we definitely want to be mindful of the time frame, the time horizon for our evaluations. Over what period of time are we talking about when we're talking about pension benefits or salaries? We refer to this in our profession as duration. Those that work closely with investments have probably heard this come up with a bond portfolio. It's a similar concept. It's the weighted average length of your plan liabilities and salaries when you weight those by their present value. It's usually represented in a number of years. And on the next slide, just wanted to compare what Left 2 looks like with our other open plans and our closed plans. So top of the chart, and this is based on our June 30th, 2019 measurement. What are these durations? What are these average length of benefit payments, for example? That's the duration of the liabilities. About 21 years for our open plans, and Left 2 is just a little bit longer at 22 years. Closed plans, as you would expect, much shorter. Retired population, those plans are very mature. The salaries are, we only look at the open plans for the length of the salaries, if you will. You kind of think of that as like a working career, sort of the average remaining working career. About 8 years, just short of 9 years in Left 2. So why is that important? Because we're going to talk about assumptions that apply to salaries, but we're going to talk about assumptions that apply to all the benefit payments in the plan, and there certainly different durations are involved. This is just here more for your reference, but I just want to mention, how do you select long-term economic assumptions? It's certainly not easy. We don't have a crystal ball. Like Mitch said, we can't provide any certainty in this area, but we do have some guidance from applicable actuarial standards of practice, and that is very helpful. And I want to be very, very transparent that this work involves a fair amount of professional judgment, and our judgment is informed by education and experience. But I certainly understand that you may have different opinions and in your experience apply, different judgment. I'm also just not trying to convince you that I'm right and it's the only right answer. That's really not what this is about. So with that bit of background, I just want to then conceptually talk about how we approach these things. And sometimes you might hear us say, we take a building block approach to setting assumptions. And I think this graph does a good job of showing you that each building block, and it all does start with inflation and national inflation, to be specific. That's the dark blue bar. And then we add on various building blocks. So inflation, we're applying that to model things like the left two post-retirement COLA. Well, that's a COLA based on regional inflation in Seattle, Tacoma, and Bellevue. So we're going to be mindful of what's happening in our region and not just in the nation. So we add a regional building block on top of national inflation to model inflation. Same thing is really applying in general salary growth. That's the salary growth of our members in this region. So we want to be mindful of regional inflation for salary growth. The only other building block for salary growth, when you look at it from an economic perspective, is real wage growth. And I'll talk more about that later. This is just setting up the building block concept. And then investment returns, theoretically, you're talking about the total investment return. Sometimes I'll refer to this as the nominal investment return. That's when you include the effects of inflation. If you were to back out inflation, you're left with the real rate of return. Really, that's just inflation. I'm sorry, that's the return when you back out inflation. So this is the conceptual model that we're using, and I'll reference building blocks probably multiple times as we go through this presentation. A couple other points of background, relevant data. What data are we using for setting these assumptions? We do look at history, but we mostly rely on relevant forecasts, right? Because we're not trying to replicate the past. We're trying to estimate the future and come up with reasonable assumptions for the future. And one thing you have to be really careful about, if you rely too much on historical experience, those conditions may not be present today. So when we look at historical data, we're very mindful of whether or not those conditions are present today, or if conditions are going to change in the future. And given the purpose of these assumptions and how we're going to use them, pension funding, looking to the future, we're going to put more weight on long-term forecasts than short-term forecasts, which is a challenge because there's certainly a lot going on right now in the short term, and we're going to touch on some of that. So with that background in mind, just going to go through a couple slides on inflation. Again, trying to just boil this down to probably the most key considerations. We start by looking at national inflation forecasts. There's a lot of lines here. Just rest assured, we looked at a lot of sources of national inflation forecasts, long-term, short-term. The couple that I highlight, the State Investment Board, coming in at about 2.2%. They do a 15-year assumption. Social Security, they're in a similar business to what we're in terms of modeling pension-like benefits. They provide a very long-term forecast, coming in just under 2.5. And some have very specific year-by-year projections. We're not really trying to do that with our assumptions, where some forecast some declines in inflation before they then increase. I mentioned earlier, we're mindful of regional inflation, and this table here shows you the difference between STB stands for Seattle, Tacoma, Bellevue. What have we seen in that region relative to the nation over various slices of history? And then the difference on the far right-hand column, which is positive, meaning that our region, the inflation in our region, the Seattle, Tacoma, Bellevue, it used to be Bremerton, they changed that, it's always been higher. That difference has always been positive, and it's been increasing. So we're not seeing any data that suggests that this is going to reverse, and we're going to continue to assume higher inflation in our region, 0.4% per year, to be specific. And I'd be remiss if I didn't speak. Oh, sorry, sounds like we have someone that has a question.
Yeah, excuse me, Matt. This is Mark Johnston. I was wondering why, in your opinion, that the local inflation rate has been higher than the national inflation rate over the last 30 years.
That's a great question, Mark. I think I think one of the main drivers is housing. The CPI is a basket of goods. One of the most significant baskets of goods that seems to be outpacing the rest of the nation is cost for housing.
Okay, thank you.
You bet. So yes, I'd be remiss if I didn't talk about the inflation we're experiencing right now in 2021, and it's been significant, and it's certainly higher than the projections that I was showing you and some of the historical inflation that we've seen. But we believe it's going to be temporary. That's consistent with the Federal Reserve position. I have a few quotes here from the chair of the Federal Reserve for your reference. Respect their opinions, obviously, at the national level, but also commentary from the Washington Economic Revenue and Forecast Council is very similar, that they have the same expectation. And a lot of this is recovery from the pandemic, where we've seen supply chain constraints. They're still there now, and the recovery of prices and services that were driven down during the pandemic. We're also starting to see some moderation in this high level of inflation. I think the July numbers year over year were pretty high. I think the August numbers are starting to come down, so we'll see. We're not there yet. But it's encouraging to start to see some numbers indicate that perhaps some of the short-term inflation is starting to moderate. All right, hard transition here to our second assumption with a fair amount of background, because this one, I have to admit, can get a bit confusing. And it's the general salary growth assumption. I just want to start by a bit of a refresher that we look at this and model it with two different sources of assumptions: an economic assumption, economic sources of salary growth, inflation, which we just talked about, everything above that, which is considered real wage growth. We also look at demographic sources of demographic sources of salary increases and make an assumption. You probably heard us refer to this as service-based salary increases, things like merit or longevity or step increases. I think teachers is the clearest example where there's a statewide salary schedule based on years of service. And any other source of demographic salary increase is going to go through this part of our model and assumption. And we combine both these economic and demographic sources to model total expected salary growth. But today, we're just talking about the economic assumption. And since we just talked about inflation, to set your real wage growth assumption, the only thing that's left is, to set your general salary growth assumption, all that's left is real wage growth. But a little bit more context, because that's fairly conceptual. Let's talk about some real numbers here. So this was actually Mitch's suggestion, which is an awesome suggestion. Let's look at our actual valuation data at our last measurement. You'll see the salaries for each retirement system, and obviously you can hone in on left 2 there. That's in millions, so 2.2 billion in salaries expected for the year. And then what do we expect the growth of that when we apply our economic and demographic sources of salary growth? So currently we assume 2 3/4 inflation each year, 0.75% real wage growth. Those two parts comprise the general salary growth. We also apply our service-based increases, all the demographic sources of salary increase. And for left 2, that leaves about 2% on average for service-based salary increases in the year 2019. So obviously, that wouldn't apply in every year, because as the population on a closed group basis, as that population matures, I think we all know you expect your service-based salary increases to fall off as you approach retirement. But that's what it looks like in 2019, just to sort of put the current assumptions in context. And again, today, just focusing in on the economic sources of salary growth. And in particular, since we just talked about inflation, we're going to hone in on one slice, real wage growth. All right, a busy slide, but I think hopefully hopeful data. Setting this assumption is a challenge, but so before you dive into the numbers, if you can, recognize that we don't have as hopeful data in this area as we do some of the others. You know, there isn't a forecast on, you know, real wage growth for Washington retirement system salaries. And also, we don't receive data specific to a source of salary increase. So what I mean by that is when we get data reported to us by the Department of Retirement Systems, it's just telling us what someone's salary is, and we can compare it to the prior year. We don't receive data that says this individual was promoted, or this person got a general salary increase, or this person got a step increase. We have to look at the data and come up with methods that enable us to sort of estimate what that looks like. So the technique that we use, and this is common in the industry, is to look at the observed growth of the average salary of an active member over various time periods. And the big assumption that we apply here is if that population is stable, and what I mean by that is if their years of service are relatively stable year over year, you're able to, in essence, isolate just the economic sources of salary increase. Again, big assumption if the population is stable. No population is perfectly stable, but when we combine all the open plans together, it's the most stable slice of the data that we can bring to you. We're showing you what that looks like over the last 10, 20, and 30 years. And if those assumptions hold, then what you're left with, we could back out observed inflation, that's a fact. And what we're left with under this method would be the estimated real wage growth, which is what we're talking about here, what we're trying to set an assumption for. And you're seeing across each one of these categories, you know, observed growth and average salary has been going down, consistent with observed inflation over the last 30 years, 20 years, and 10 years. And for the most part, you're seeing a downward trend in estimated real wage growth. Now, you might be asking, you know, why aren't you showing me just the data for left two? Why aren't we setting this assumption based on left two data only? I think it's too small of a set of data, and also it's left two population in terms of the years of service is not as stable as the other systems. So that stability assumption starts to break down a little bit when you just rely on left two for this data. So that's why I'm showing you all open plans aggregated. Last bit on this assumption, or one of the last bits on this assumption, is looking at forecasts. There are forecasts available at the national level, which have some relevance. We don't put too much weight on this. The CBO, the Congressional Budget Office, and the Social Security Administration, they have forecasts for productivity or real wage growth. And it's changed. We look at this every 2 years. It's changed since our last study. But I want to know, we don't rely on these specific forecasts, these point estimates, when we recommend an assumption for left two, for various reasons. Those forecasts rely on a broader definition of wages than our pensionable wages. They're also looking at things like fringe benefits. I don't believe that those forecasts have they don't separately break out a demographic component. So I believe they're including demographic and economic components when they're talking about real wage growth. And remember, in contrast, we do have a separate bucket for demographic. And if we didn't, you'd be throwing it into the real wage growth category. But the takeaway in terms of looking at these national forecasts is they have decreased. So they're saying that they expect over the next 10 years, productivity at the national level and real wage growth declined about 11 to 13% from our last study. Last slide on, or last bit of background on real wage growth. Similar to the discussion about inflation, well, what about the possibility of short-term above expected wage increases? I just wanted to also note that our general salary growth assumption, that's a possible outcome for sure. We are not intending this assumption to necessarily model every year of salary experience perfectly. I think of it as more of the average annual growth over the measurement period. And remember, this is about a 8-year period on average of future salary that we're trying to model. So we're hoping that it's going to be reasonable when you look at the experience over the entire measurement period. And certainly we're going to undershoot or overshoot the assumption on an annual basis. We also have some additional tools at our disposal. I'll just speak through, sort of summarize some of the last bullet there. It's a bit lengthy. We do have the opportunity to observe actual salary experience. And if we start to see short-term salary that's quite a bit different from what we've assumed, we do have the opportunity to make a 1-year change in our assumptions. As you know, it can take about 9 months to prepare an actual evaluation. So there's a time lag between our measurement date and when we actually produce the report. So there are situations where we can sync up the salary data with our assumptions on a 1-year basis. For LEF 2, that's not as common because it's a population of different jurisdictions, both police and fire. Salaries are not necessarily moving in lockstep. But I just want to, this is some information that I shared with the Pension Funding Council and some of the other systems. That is a tool that we've used in the past. So we are mindful of short-term deviations, and we keep an eye on our assumptions year over year.
Matt, there was a question in the chat. Is the wage growth pulled down due to high retirements and new or lower wage workers coming into the workforce?
It could, but if you go back to that assumption of we're looking at average salaries in a stable population. If it's stable, that wouldn't be happening. In theory, I'm sure that is happening because we don't have a perfectly stable, years of service in our measurements.
And going back to your previous comment too, if we're experiencing higher than normal retirements in LEF, but you don't segregate the LEF data, for this, are you looking at all the plan data aggregated?
We are, and I think that's a great question, Steve, and I knew this would probably come up, because this is probably the one assumption that feels very LEF specific. We're trying to set economic assumptions, right? So, there really shouldn't be different economics across the retirement systems. Where you're going to see different salary is in the demographic component. And you do have a different set of demographic assumptions for salary growth. We just happen to be talking about economic forces today. And thanks for calling out the chat. Sometimes I don't see the full chat, and it blocks some of the presentation, so I sometimes I miss it. So appreciate that. All right, so moving to the last economic assumption, a few more slides on this one. I think it's worth it given how impactful this assumption is. Remember, in context, investment returns for the last 20 to 25 years have covered about 70% of all pension system costs. But here's the structure. So when you look at this assumption, it's challenging. What might you want to consider? Things like capital market assumptions, which I'll refer to as CMAs. Asset allocation. How are we investing these assets across various asset classes? What are the simulated future returns net of expenses? Sensitivity analysis. How do these simulations change when we use different assumptions? And then what about the consistency between SIB's capital market assumptions and their simulations with the use that we're applying here, pension funding? So we're going to talk about each one of these. So think of this as a framing slide for our upcoming talking points. Capital market assumptions. I know we've got some folks, staff from the State Investment Board that are here. They're the experts in this space. So any technical questions, we'll certainly want to defer to them. But these capital market assumptions, they're the cornerstone for SIB's work in developing a strategic asset allocation strategy. And they are broadly, they are assumptions about the behavioral characteristics of the asset classes in our commingled trust fund. Things like volatility, how risky are these assets? How much do Do they wiggle around their mean, if you will? What about the reward? What's the potential return for these asset classes? That's part of the CMAs. And then the relationship between these asset classes, do they move together? Do they tend to diversify each other because they move in opposite directions? Those are all part of the CMAs, and they're very, very informative for this work. Their time horizon, they being the State Investment Board, these capital market assumptions are intended for a 15-year time horizon. So they're the assumptions that they believe are appropriate, and I think they are as well, for a 15-year time horizon. So you remember earlier, we were talking about some different time horizons. So keep that 15 in mind for down the road. And probably one of the most important comments here is SIB, I really appreciate the partnership and that they provide these CMAs to us, they provide simulations to us, but I want to be really clear, they're not intended to develop actuarial assumptions on their own, right? They're not an output to this process, they're just an input. They help inform the selection of actuarial assumptions, but we certainly review them, we certainly make adjustments. It's a great starting point, but yeah, not the ending point. And I'll talk about why later. So I mentioned earlier the importance of the CMAs and also how they've changed, right? Every 2 years, I bring these recommendations to you. So if the capital market assumptions have changed, it's likely that the recommendation is going to change. So this chart is just showing you for each asset class in the CTF, the expected 1-year return from the CMAs in 2019 to the CMAs that we used in this 2021 study, and the standard deviation, that's the volatility measure that I mentioned. How has the standard deviation changed from 2019 to 2020? The 1-year expected returns for each asset class have all decreased, and we've seen sort of mixed changes to the expected standard deviation or volatility. You might be asking, why would we expect lower future returns? I'm going to go through some conceptual stuff here. Also provide a slide that I think is really helpful from an historical perspective. But I'm also just going to cut to the chase because I think we all can understand this. What goes up usually comes down, right? And we are at an historic up right now in our markets, in our asset classes. That's the simple way I could put it. But now let's talk about the theory behind this. Just want to talk about assets and what they represent. Financial assets represent future cash flow. And for example, let's look at equities. They generally represent future earnings and dividends where applicable. And the markets put a price on that expected future cash flow and the perceived level of risk for that investment. And certainly the prices can vary by asset class listed above. And I just focused on equities because we're probably all most familiar with that. The discount rate that equates that price, the current price, with the expected cash flow, that's the expected return. So the markets are telling us some information about what they expect for what the market expects for returns. And higher prices come from lower discount rates. That's just a financial fact when you look at the math. And higher prices imply lower future returns. So that's the theory, that's the finance theory. The next graph, I always try to bring in one graph that I think really sends a strong message and one great graph, as I usually say in every presentation. I think this is the one for me. And it shows you an example of why we could expect lower future US equity returns. So important, right? US equity returns. That is one component of the CTF. They invested in global equity. It's roughly 50-50, US versus non-US. But this graph is looking at US equity returns. It's showing you the relationship between the Shiller price to earnings ratio and the following 15-year return. This is not a forecast. This is actual historical data. And you see a very strong correlation here when the PE ratio, the Shiller PE ratio is high, which is where we are now, about 33. You see that the following 15-year US equity returns hovered around 5%. In contrast, when you see the starting PE ratio on the low end, something like 10, for example, you see that clustering around 15%. That meant that in those historical periods, when you had a PE ratio starting out at about 10, the following 15-year returns were 15%. So we are currently in an environment on the low end of this graph, that line you see coming down through the graph on the right-hand side that says December 31, 2020. That was the Shiller PE ratio when SIB did their latest capital market assumptions. And that current PE ratio is hovering around the same level. So we're seeing very high PE ratios for US equity returns. And if these historical trends hold in the future, we would expect US equity returns for the next 15 years to be significantly lower than what we've experienced in the last 15 years. I focused on US equity returns because this data is readily available, and it sends a pretty strong message. You might be asking, well, what about global equities? Non-US equities. The PE ratios are not quite as high, but they are still on the high end. Things like real estate, I think we're all sort of seeing that and living that, right? Real estate prices are very, very high in relation to income. Interest rates are also very, very low. So keep those things in mind. All right, so the asset allocation. Talked earlier about the importance of looking at the asset allocation, right? Because how you invest your assets is going to have a big impact on the returns you expect. Did the asset allocation change since our last study? Short answer, no. As you can see in this table, same values. And if you're not as familiar with this is just telling you what percentage of the entire CTF is invested in various asset classes. The largest asset class is global equity. The target is to have 32% of the CTF in global equity. And the smallest, as you would expect, is cash. And any future change to this asset allocation could lead to a different recommended return assumption in the future. So that's an important piece of disclosure. Now we're going to turn to simulations. Think of that as like, here's the forecasted part of our work. You take those capital market assumptions, you apply them to the asset allocation that we just reviewed. Because remember, each one of those asset classes has an expected one-year return and a standard deviation and a correlation amongst each other. You put that into a model and you run simulations. And then you summarize them. You can sort them from lowest to highest. And I can show you the percentiles here, which I have. And so for example, what does it mean? If they've run 2,000 simulations, the 75th percentile just means that 75% of the returns are less than 8.8 for the CTF, and only 25% of those simulations are above 8.8. We focus on the median because half the outcomes are above the median by definition, and half are below. That's why it's highlighted there. And then we show you the difference between these simulations 2 years ago and what we're seeing in 2021. And the median return has come down from 7.4 to 6.9 when you look at it over a 25-year period. I'll also note that these simulations are net of investment expenses. And just to back up, I think I already covered, like why would these be coming down? Well, for the reasons that I just mentioned, right? I think, we are in a market high. We are very historic levels, high levels of prices to earnings or values to income. And over the next 10, 15, 20 years, we're expecting returns to come down. And these simulations are consistent with that. But I did mention that those simulations are based on assumptions, right? You take those capital market assumptions, you put them into a model, you're making assumptions. So we want to be mindful of how might the median return, for example, change if we use different assumptions. So we look at changing the underlying assumption in the area of private equity and global equity, because those two assets are 55% of the CTF. And I'll just walk through the table here. So under the base assumptions, right, the assumptions unadjusted, we saw that the median return over 25 years was 6.9%. If private equity were to earn 1% more over that period than what was in the base assumption, that median return in the simulations would go from 6.9 to 7.1. If global equity by itself earned 1% more each year than what we assumed in these simulations, the return would go, the median return would go from 6.9 to 7.2. And I'm going to call that out because I think it's another really impactful piece of data, especially if you're really questioning the accuracy of these assumptions, and are they too pessimistic? Perhaps, or are they too optimistic? Perhaps. But even if you increase private equity returns by 1% or global equity returns by 1% each year from what SIB assumed, you still fall well short in this simulation of the current 7.4% assumption. So to round this out, the investment return discussion, what are some other considerations before recommending a return assumption? I mentioned earlier the importance of the consistency of these simulations and SIB assumptions with our use, which is, we're not doing tactical asset allocation or strategic asset allocation. We're trying to use them to set an assumption for pension funding. So one of the things we look at, SIB makes an assumption about inflation, so do we. We need to make sure they're consistent. Our assumption is higher. Our national inflation assumption is higher than SIB's. So we adjust the simulations to be consistent with our assumption so that the set of assumptions, inflation, real wage growth, are consistent with the return simulations. The time horizons are different. SIB is applying assumptions over 15 years. Left 2, it's more like a 22-year period. So if you're looking at things like prices reverting to a mean, if it's going to revert to a mean over 15 years, that's going to be a sharper decline than if you are reverting to a mean over 22 years. So we're mindful of this. We look at it, we apply our judgment and make some adjustments. Some of them are offsetting. They're not all moving in the same direction. So to summarize on the recommendations, so the result of all this analysis, what does it lead to? Just comparing the current assumptions to the recommended assumptions, no change to inflation, decreasing the general salary growth from 3.5 to 3.25, and lowering the investment return assumption from 7.4 to 7%. I've hit on this earlier, but I think perhaps I'll do it one more time. Just remind you that we are very mindful of the consistency of these assumptions, and we see them as a set of assumptions, not like an a la carte menu, if you will. And we recommend that you review them as a set. Whether you adopt them or not, if you have a different opinion, you'll want to be mindful of making sure they're consistent. So I'll provide an example. The easiest example is if you start messing around with inflation, but you don't change your general salary growth or your investment return assumption, you might have an inconsistent set of assumptions. And now I'm going to transition to some of the funded status impacts and contribution rate impacts. If you adopt the recommendation, it will decrease the plan's funded status in the short term and increase minimum contribution rates. Everything that Mitch showed you was earlier, which was before any change to assumptions. So we'll start with what's the funded status impact? And this is preliminary analysis. We're looking at our latest measurement and the next 3 projected measurements. The baseline projection is what Mitch showed you in that graph. I've just turned it into a table. So that's under current assumptions, and that's reflecting returns through June 30th, 2020. When we include the impact of the phenomenal investment return that Mitch spoke to, that's your FY21 return. And you see pretty significant, it starts to compound as we recognize that through the asset smoothing method. You see some pretty significant expected increases due to those above average returns. We compare that to what would happen to the funded status if you were to adopt the assumptions as in their entirety. What would happen to those projected funded statuses and the total change when you add those 2 together? leading to your new projected funded ratio at the bottom. And again, as Mitch mentioned, this is a, as expected forecast. Obviously, the actual projection is going to, the actual results are going to vary to the extent that we see future returns that vary from our expectations. Contribution rates. We're focusing in on the minimum contribution rates and how they would change using a similar, sort of a similar format where we start with the baseline projection. What did we know before this recommendation and before, well, that's actually the only thing that would change this, because as Mitch mentions, asset returns don't change your minimum contribution rates. But if we change our assumptions, that would lead to a change in your minimum contribution rates. So I'm showing you, in essence, what it would look like before the recommendation, and what's the 90% minimum rate, what's the 100% minimum rate. And then the new projected rate is those same measures when we reflect these new economic assumptions. Lower expected returns are really driving the change here. That's going to lead to higher minimum rates, both the 90% level and the 100% level. But the new projected rate under the new assumptions does retain, even at the 90% level, does retain quite a bit of stability with your current 8.53 rate, more so than the projected baseline, which would go down to 7.74 under the current assumptions. So just one more concluding slide. Funded status impacts. When you look at those, we're really talking about what's going to happen, because lower returns are going to bring down the funded status, and higher contributions would normally be required to offset those lower expected returns. A lower assumed rate of return means that the present value of your benefits are higher. We focus on the short-term effects because the long-term effects are going to happen regardless, right? The actual cost of a pension system, the actual funded status, right, down the road is going to be based on actual experience, the actual cost of benefits, the actual investments that we earn, the actual expenses that the program has to pay. We're just trying to estimate those with reasonable assumptions. I think it's important to note, because people do question, why aren't you showing a longer term forecast? I think it's misleading to tell you what a 50-year impact of an assumption change is, because over that 50 years, actual experience is going to emerge, and you're likely going to change your assumptions either way. The expected funded status, as you probably saw through 2025, remains at least 105% under the recommended assumptions. And I think that I'm highlighting that for obvious reasons, because one of your funded status, one of your funding policies is tied to the funded status and 105%. So I think that's a key takeaway from the recommendation and our projections, that we expect it to remain at least 105% under those short-term projections. The last time we looked at these current assumptions, we found them all to be reasonable. I think that's another important aspect. We're providing our best estimate. At the end of the day, as your actuary, we need to certify that the assumptions are reasonable. Reasonable assumptions don't have to be our best estimate. And in the appendix, I won't go through it today unless you would like me to. You'll see some references on other states' economic assumptions. We call them some peer comparisons, and historical Washington state assumptions for your reference. And with that, I'm happy to answer any other questions you have.
Hey, Matt, I have one. So usually, I waited a little while to ask this. You're on a roll. I didn't want to interrupt you on this. I want to go back just a little bit, maybe all the way to slide 13. And first of all, I know I always ask you a question, ask you to take a position or draw a conclusion. I'm not going to do that today, because you always politely and appropriately decline, and I understand why. But Steve Nelson touched on this just briefly when you talked about having all the retirement systems taken into consideration. So you had a population base that was adequate enough, I think, to draw some degree of certainty as to your projections on this, talking about salary growth, economic and demographic assumptions. And you didn't limit it to public safety. Steve touched on that, and that we have political implications that are happening that would tend to
Turn the heat up a little bit. Just open the door.
the political issues that would change things underneath our feet and affect assumptions here as to demographics. I think we also have something that the other systems don't have in a binding arbitration or West Coast comparables also that would impact our salary growth rate. So, I mean, just as a reference point, have you looked at, have you cut out or taken out public safety out of this and done a comparison contrast so that you'd be able to have some degree of confidence that using a larger population base out there actually would, give you a degree of confidence in as to its accuracy with public safety?
Great question. Thank you. I know we looked at left to by itself. So we looked at left to aggregated with all of our open plans. We looked at left to by itself. I don't know if we looked at, left to with, for example, State Patrol or PSERS. PSERS is also a really, young, maturing system. And I also want to note too, I talked about consistency of assumptions. I don't think that, if you were to retain the current general salary growth assumption, if you felt that was more prudent, I don't think that leads to an inconsistent set of assumptions. So I just want to be on the record for that. This is a challenging, like I said, I find this one even more challenging than the rate of return assumption. I think they're all, it's hard to say that any of them are going to be accurate, but in terms of, the data that you have and the methodology that's available to you, I think we're most limited in this assumption. Now you are working with a very healthy plan, which makes me less nervous, in terms of if we get this wrong, what's the impact going to be? I also encourage you in your role as board members, we learn a lot from you. So if you become aware of things that are happening in your populations, especially around salary, please share it with us, because we look at these assumptions every year. I'm bringing a recommendation to you formally every 2 years, but we're looking at this constantly. And our goal is to be as accurate as we can with these assumptions, within reason, right? Because we know we're not going to be able to hit the mark every year, and they really are more longer term averages.
Perfect. Thank you.
Question, Matt. Mr. Chair, is that okay? Representative Berquist here. So kind of along that line of thinking, if there was no change on the salary growth piece, what would that impact be? Or do you have some numbers on that already?
I don't, but we can follow up with you. The investment return is really driving the change, but there is a little bit of an offset from assuming slightly lower wages. I just don't have that in my back pocket, but we can follow up with that.
Thanks.
Those charts I showed you at the back, change in funded status and change in minimum rates, we can update those with just the change to the investment return.
Matt, I think based on the experience, the concern is not that the change in assumptions is that perhaps it would be more conservative for left. So for instance, if the board chose not to adopt the general salary growth assumption, that would add more good news to the forecast. And I think the general perception is that maybe left right now in terms of salary growth is in line to experience more bad news compared to the other plans. So would it be possible to talk with you guys about what something like that would look like?
Certainly.
Thank you.
Other questions for Matt? Not seeing or hearing anything in the chat room. So, all right, Matt, thank you very much.
Welcome. Take care.
Appreciate it. All right, Mr. Nelson.
You guys have been doing a great job. We're at the point in the agenda now where Tor, the assistant AG that's assigned to the board, conducts regular required board training. And with that, I will turn it over to Tor to give you an overview of what he's going to be presenting you with today.
Good morning. Still, tough act to follow. Mitch and Matt do an incredibly good job, but I'll do my best to keep you awake. So it's been quite some time, but having said that, I'm very mindful of not repeating the same thing year after year, and always harping on, whether it be public records or OPMA or some other aspect that you probably have heard too much of. I was inspired a little bit this year sitting through this effectively the same required board training at the Washington State Investment Board back in June. We had one of our special assistant attorney generals, that's outside counsel, a gentleman by the name of Harvey Lederman from Reed Smith, come in. And he did a very well received presentation where he delved a little bit deeper into the whys that come along with fiduciary duty and board service. And so I used that basically to inspire a little bit of what I was looking at today. If we could advance the slide. Thank you, Tim. And in particular, when you start looking at why, you inevitably start looking at a historical perspective, or well, how did that develop? Where did that come from? What is it? How can history inform us? And this is not a formal history lesson. It's not my area of expertise, to be quite frank, but I'm just want to share with you today some of the things that I thought were really cool as I delved into the history of fiduciary duty and boards of trustees, because I think it gives a really nice perspective as to where the board is, not in the course of the last 5 years of history, but in the course of the last 4,000 or 5,000 years of history, and really informed me a little bit about really what our place is. And I just wanted to share some of the fun facts, basically, that I came across as I did that. And then, in order not to be totally remiss, also to tack on and talk a little bit about the usual suspects, if you will, and to do a little brief reminder or refresher on some of the core elements of your duty that we're obliged to cover, just so as not to be totally remiss. Can we advance the slide, please? So this is really when I looked at sort of the why, really we always go to the RCW 4126, our enabling statute relating to board governance, to give us really the big picture view of what it is that the board does. And ultimately the legislature in their wisdom and in, as it turns out, some degree of historical context, chose to establish a board of trustees who are responsible for exercising fiduciary responsibility and the oversight of those pension management functions assigned to the board. And then the same chapter basically sets forth, the entire balance of the chapter sets forth, breaks down those responsibilities. But these two concepts here are at the very core of the board's function. And I guess I'm going to look at this a couple of different ways. One is they could have chosen a single trustee, but instead they chose a board, right? So that's like one differentiator. And then we look at the concept of trustees exercising fiduciary responsibility. What is it that differentiates trust concepts from fiduciary concepts? And ultimately not not much. They are effectively the same. Trustees are required to exercise fiduciary responsibility. That's has been the law of not just Washington, but pretty much all Anglo-American systems for a long time. But fiduciary responsibility can also exist outside of the context of trustees or a trust, right? A trust or trustees will always be required to exercise fiduciary responsibility, but fiduciary responsibilities don't always have to be associated with trustees. Can we advance the slide piece, please? So these are the questions that I started to dive into, and why a board rather than individuals? What's up with fiduciary and trustee responsibilities, and how, where do they come from? Could we advance the slide, please? I just talked about this. We can move it right along. Next one. Always look to dictionary definitions and etymology. When you talk about, if you really want to dig deep, okay, the one fun thing that I looked at when I was looking for the definitions of all of these words and the roots or the origins or the history of the words is, what is a board? It's a group of people constituted as the decision-making body of an organization. But where does the word board come from? Why doesn't it just say a group? And at the end of the day, one thing that I came across was that actually a board, the word comes from the fact that typically they gathered around a table or a board, and the quantum of a board of trustees is in fact that which fits around a table. And that was true historically, and it's true today. We sit across, we are the group that sits around the table, even though we're doing so virtually today. Can we advance the slide, please? Trustees, if we look into the definition of the current definition of that and the source of the word is, and this basically will inform a little bit of where I go in this exploration. It's the individual given control of the powers of administration of property held in trust with a legal obligation to administer it for others. So as I said earlier, it's trustees, there must be a trust in order for there to be a trustee, but fiduciary responsibility is not necessarily linked to a trust. And of course, our responsibility or your responsibility is to oversee the assets of the Left 2 board. But trust today has a very common meaning, and it's one where I think we have the common usage. The word means what it sounds like it means. But if we look back to the history of that, it's the reliance in an etymological dictionary. It is the reliance on the veracity, integrity, or other virtues. And what better example of that is there, of course, than our chair, who we have pictured here at some recent function. I'm not sure which one. Maybe he can tell us about that later. Could we advance the slide, please? Fiduciary is the fiduciary responsibilities, and the word fiduciary is not quite as intuitively obvious, but I did appreciate the fact that AJ shared with us a picture of his retriever who sat at his side earlier today. And ultimately, it came to me that the Roman root of the word fiducia was a right transferred in trust. But that is where the root of the word is fid. Fidelis also appears in the Marine logo. It appears in the FBI motto, and the idea of a loyal dog who remains so to his master at all times. That same concept, and the same word that is embodied in basically the name, is what carries through here. But the one other element of the word fiduciary that is consistent with the concept of trust or trustees is that you're managing the property of another individual. The difference between fiduciary and trust is that fiduciary, you're managing it, but the ownership or the control, the ownership doesn't necessarily shift. In a trust, the ownership has shifted. In a fiduciary, you could actually hypothetically hand back the assets to the person whom it belongs at some point in time. Could we advance the slide, please? Before we dive back into to trust and fiduciary relationships, I did want to try to touch on just conceptually why the legislature, and for that matter, why any number of other constructs basically choose a group and not an individual to exercise this type of responsibility over the assets of others. And, you know, and ultimately that's, I guess I'm going to, given that this is a virtual presentation, I'm going to advance the slide, but I challenge you to think about why that might be. And ultimately, it's you know, these are the things that struck me. One was continuity. At the end of the day, a board of trustees is a perpetual thing. Board members come, they come to the board, they drop off. It rotates through time. If it was an individual, then at the end of the day, you might lose, you know, the service of the board might be interrupted. So that's, I think, a very important distinguishing characteristic. Another one is that clearly with more people, two minds are always better than one. There's a limit perhaps to that, but adding the collective skill and wisdom of multiple individuals to any endeavor is likely better than that of any single person, right? Conceptually, one of the things that also is embodied in our statutes, both the Left 2 statute, but also other Washington State board compositions, is a concept of sort of this representation from various stakeholders, right? And this is, you know, I bring this up because really it's sort of new, right? That the idea of representative, almost it's a mirror of representative democracy, right? Where on our board, like in other decision-making structures, there are representatives of both the employers, firefighters, the police officers, and other stakeholders, and bringing the ability to bring those different perspectives is one which couldn't be done if it was in the hands of a single person, right? The last thought that I was able to come up with was one of sort of collective accountability. A trust or a group of people has the ability to hold each other accountable where an individual does not. An individual, it's much harder to self-assess than it is to take part in a group assessment. And it's also easier to demand more of a group than it is of an individual. And you know, ultimately it's much harder for any one individual to run away with the funds or to engage in any malfeasance if you have a group of people watching, right? And I think that's something that clearly helps to inspire trust among the broader stakeholders, whether they be the beneficiaries or the funders of the entity. Could we advance the slide, please? So having talked a little bit about why it's a group and not, or why the legislature might have chosen a group rather than an individual for these purposes, you know, as I told you, it was a little bit of a historical explanation, or exploration, excuse me, not an explanation. And it turns out that the first references to a fiduciary relationship in written law or in written history, they arise in Hammurabi's laws. Now, Hammurabi was a monarch or a king that governed in Mesopotamia, which is at the confluence of the Euphrates and Tigris rivers, back at around 1700 BC, so about almost 4,000 years ago. And the first place that you really in written history or in laws, or one other thing I should mention about this tablet right here that we show pictured, that's in the British Museum, and that is a piece of rock that came off of a column that was in one of the larger cities in Mesopotamia. And it basically is the law as written and as displayed or shared with the populace to basically demonstrate the fact that it applied to everyone, right? or so it's thought today. But one of the key legal concepts that was embodied in those laws, and in fact written on some of these tablets, was the idea of an agent, of a merchant-agent relationship, and one where merchants would set forth the standards of basically knowledge and trust that were expected of agents for merchants when they went out and conducted commerce. Okay, so this is really the first time that these concepts have appeared, and it sort of makes sense because ultimately, as I think about the functions of the board and the slogan that the Left 2 board has today, which is "We serve them so that they can serve us." Okay, here in Hammurabi's laws, basically it sets forth the expectations that a merchant can place on his agent that is sent out perhaps on a camel caravan to buy spices in some far off distant land. He can expect that person to engage, to basically be true to his instructions and to be true to his expectations as set forth in these constructs. And another way of looking at this, which is a little bit speculative on my part, admittedly, but that is that ultimately these are the beginnings of sort of these. Law is ultimately about the relationship of people within society to each other and the expectations that we can have. And but it also is a little bit of the history of capitalism, because if you couldn't trust your agent to go off to on his, on basically a purchasing or trading or selling expedition and not be clear what those expectations are, if you had to do it yourself, society would be nowhere near as efficient, right? We need for there to be specialization of skills. We need the law to set forth relationships for commerce and things like this, right? So anyways, that's just thought process that sort of this triggers for me. And as you all know, I'm a bit of a super geek when it comes to these types of things, but just sort of sharing this with you conceptually. We could advance the slide, please. Another really interesting thing that I came across was the early origins of trust law and fiduciary duty in English law. And here I have chosen to illustrate some of these concepts, what most of you probably will recognize as an illustration of a crusader off to reclaim Jerusalem from the heathens in the late Middle Ages. And it turns out that the Anglo-American legal tradition, or common law, some of the earliest references also to trust law and fiduciary duties came from the fact that the head of the household, the estate, the warrior, the lord of the castle, who was expected to go off on a multi-year mission, what did he do with his lands? What did he do with his estate? How could he be assured of the fact that the lands were not going to go to waste? His employees were going to be mistreated, or his serfs or feudal, underlings. His family was to be taken care of, and ultimately there was legal constructs emerged, where basically fiduciary standards were established, okay, and laws relating to trusts, but also the administration of land developed some of the same concepts, basically, which continue with us today. And one of the most interesting developments that came right at this period of time was the idea of accounts, or the fact that a trustee or a fiduciary, in this case, it was a fiduciary because there was an expectation that the knight would hopefully return victorious, having reclaimed Jerusalem. So the land did not go into permanent, it did not go to someone else. It retained title to the land, was retained with the Lord. But there was a duty on the part of the fiduciary remaining who administered his land to provide an accounting. And the accounting was not just you harvested X bushels of wheat in year one, and in year two it was Y, and this many goats were born. There was also an expectation in the accounting that you would demonstrate that the land and the people were put to their best uses. And as some of you may be familiar, I know we have a couple lawyers on the board, and there are these comments, there are these concepts like adverse possession and things like that. But ultimately, it made sense that land should always be put to the greatest utility or the greatest use for the common good. And once again, this is the sort of the intersection of where law and societal good and societal goals all intersect. But this is, as a just, I mean, if we want to talk about historical continuity, here we are today, and here they were then. If we could advance the slide. The next sort of evolutions in fiduciary trust law, I mean, I think came a little bit in the late, it basically always came as people pushed out beyond their boundaries. And here I have two illustrations that I wanted to touch upon. One is the gold coins on the right, that VOC logo on the very far. That's the logo for the Dutch East Indias Company, which at its time was the single largest, really entity or corporation or nation even that as a percentage of world GDP that probably has ever been established. Basically, in the 1600s, they ran a huge portion of the entire global trade in textiles, spices, pretty much everything that moved and was desired in Europe and came from Africa and Asia. And what was interesting about it is that the Dutch basically created the idea of really stocks and bonds is what it boils down to, and shared ownership. And with shared ownership, there came, you needed to demand a certain series of, or establish what the duties and responsibilities of the parties to each other were. And that's one where fiduciary and trust concepts also came into play. Not just the duties of the managers of the company to their stockholders and their bondholders, but also the duties perhaps of the agents out in the field, far removed from headquarters in Amsterdam or Rotterdam, what their duties were vis-a-vis the entity itself, right? If we could advance the slide, please. Simultaneously with that, you also in Holland, I brought in this illustration for a couple of different reasons. One is, early human history basically was very hierarchical, right? And there was always, I shouldn't say always, but for the most part, governed by kings or monarchs or lords or something, and then there were those who were lower on the totem pole. With the Renaissance and development in Europe in the 15 and 1600s and Lutheran, basically religious developments and Calvinists for that matter too. In Holland in particular, there came to be a very well established expectations of charities and tithes. Okay, where basically members of society and members of church, which was 100% overlap at that point in time, were expected to donate a certain portion of their earnings or incomes every year for charitable purposes as part of a tithe. And it was boards of citizens that were established to administer those funds and to distribute them to worthy recipients. And in a way, these boards, like one pictured here by a famous Dutch painter, Van Dahl, I think his name was, not Rembrandt, although it looks a little bit like Rembrandt. These boards, you could, in a way, they were early precursors to today's disability boards, okay? And to some extent, even a board like our own. And what's interesting about this painting as well, not just that, but is that they are all equals, right? These are not lords that sit up on a throne that pronounce judgments or to dispense wealth. This is a group of equals that is basically that is allowed to make decisions, or that is empowered to make decisions regarding the administration of charitable funds for the distribution of other members of society in need. So in a way, this is one of the world's oldest pension boards that you're looking at right here. If we could advance the slide. Very briefly, this is a painting of a young king receiving education. The only reason I threw this in here too as well is we in the development of fiduciary law, there's also the idea of administering an estate or power for that matter on behalf of someone who is a minor or disabled, right? And this is another important source of these same duties that we adhere to today. If we could advance the slide, please. Enter industrialization some 200 years ago, and the rapid economic growth that came in the 1900s. I picked this slide here because it was really with the advent of industrialization and railroads that you had the development of modern corporations that grew a huge amount of even cross-border investment, where the great bulk of railroads in the United States were actually funded with I believe, European money. And that was stockholders looking to get rich basically on the development of these ambitious schemes that would open up the continent to commerce, right? And what was important about these from a fiduciary and trust perspective is that they really, in the 1900s is when you saw the development of modern commercial law, including modern corporate boards of directors who basically who were appointed or expected to protect the interests and oversee the corporation on behalf of the stockholders. And there is a large overlap between the expectations for boards of trustees, in pension benefits and in other contexts, and also in a corporate context, and the growth of the two was intertwined over time. So this was a huge leap forward, and it is that law which is basically still with us today, and can serve as a precedent in some regards to what we have today. If we could advance the slide, please. Moving on to really modern day pensions, as opposed to the and I say modern day pensions because there was evidence that the Romans paid their military service members actual pensions for military service, okay, and that they could expect to collect basically for life, even at the end of their service. But for work, the earliest records of pensions were also in the middle of the 1800s. And I have American Express's logo up here because in 1875 was the first commercial pensions, and they were actually offered by the same American Express company that is around today. And that's what they did before credit cards. Was very small scale, but it was there. And the gentleman on the right, that is a young Otto Bismarck. And what is very interesting is that Germany was actually one of the first places with a large, significant portion of its workforce that became entitled to pension or retirement benefits. And it was largely as a result of Chancellor Bismarck, I think it was a chancellor, seeing that this was a huge way of countering the influence of Marxism in late 1800s Germany. Anyways, just interesting data points on the timeline of history. So if we can move on to the next slide. In this last century, and it was really in the 1920s, 1930s, 1940s with the labor movement, but also with sort of the world shrinking and law becoming standardized, that fiduciary and trust law, which evolved over the course of that span of the 3,700 years that I just described to you, basically moved from just case law and the common law and began to be, and what we have with us today was written down in this book that you're looking at here, which is the Restatement of the Law of Trusts. This is I believe the third edition, which is just a decade or two old. But the concepts that are in today's edition and that govern us, the board today, and which have been adopted by most US states or some very close version thereof, They all came to be codified in the 1920s, 30s, and 40s. The biggest change with respect to fiduciaries and trusts from then to today is actually much more on the portfolio side. Way back in the 1920s, basically stocks, and especially in light of what happened in the 1929, in the Great Depression, stocks were not considered or equities, private equity, tangible assets, real estate, all these other investment categories that we just heard described for us as a significant part of the WSIB's investments. They were not considered prudent for the purposes of pension fund investments. What was considered prudent at the time were really bonds. And the evolution in the law, that's where the evolution has come over the last 60 or 70 years to today, where they talk about modern portfolio theory. But the other concepts have basically remained the same. And those are, of course, I'm just going to run through them quickly. The duty to administer the trust in accordance with its terms, the duty of prudence, I just touched upon that, the duty of loyalty, impartiality, delegation, respect to co-trustees, the duty to furnish information or account to the beneficiaries, the duty to keep records, and the duties to segregate trust property. Those concepts have been with us. This is when they were basically first codified, was back in the 1920s. If we could move on to the next slide, please. So to wrap all that up in terms of and imagine how all that comes together today. Really, what are these fiduciary duties that have evolved over time? You must act in the collective interest of the plans and not to promote your own interests. It's easy to see how today's duty ties back to that of the person entrusted with keeping the Knight's estate running back in 10,042, right? It's exactly the same thing. Exclusive benefit rule. Your duty to use the assets only for the members' benefits, that has remained constant for that throughout that same breadth of history. The duty to act with care, skill, prudence, and diligence in a like capacity and familiar in these matters. Obviously, that's evolved substantially over time. But at the end of the day, what we're really saying here is that we want to pick good people to be on the board who are technically skilled, who can do the job, who have the ability to inquire. I don't think that's changed. Diversification, I just touched upon that. That is an area that has changed dramatically over the years, but it has impacted mostly the WSIB and not our particular board, right? Following the plan documents. This is sort of an interesting one because on the one hand, we say follow the plan documents, but on the other hand, I'm just going to mention as a little bit of a counterweight. Even in the presentation that we just saw, Mitch's, I think it said what did he say? He said, you need to adjust and monitor. You do need to follow the plan documents, but having said that, you also need to be on top of change and keep an eye out for changing circumstances in order to adapt, right? I guess I just mentioned that because there may be times when those two come into conflict, and really looking back at history is an interesting way to evaluate that. You wouldn't want somebody who's out of touch for a long time to leave a static set of documents that doesn't take into effect the coming of the plague or the sinking of a ship or the loss of a cargo. All those things require judgment on the part of trustees. And sometimes, I'm not saying you should disobey plan documents, but I'm just saying that the two may come into conflict at times. The next slide, please. These are the potholes of fiduciary potholes. As we review this list, which I'm not going to go through them each and every one at this time, but you can also see how these have. How these have, I won't say have been historical constants, but how they may have basically remained fairly similar over time. At the end of the day, you need to think about the beneficiaries and not others. That's what all, and that has been a historical reality. We can move on to the next slide. Ultimately, codification has made it easy for us, but on the other hand, you know, you can't also overly, you know, looking at the letter of the law is to some extent inefficient. You know, if you're guided by these principles, the integrity, fairness, balance, prudence, collaboration with each other, then you'll be fine. The book isn't, codification wasn't required. These concepts, I think, have been around forever and have guided fiduciaries since the beginning of time. And if, you know, you continue to remain true to them, then we're all good. We could advance the slide. Okay, so thank you for indulging me in my trek out, you know, and sharing to some extent some of the things that I discovered as I started to look at why, or that some of the things that informed why we are today and why the board is what it is. This is the part I'm not necessarily going to say I'm going to whip through this, but I do feel like I'm obliged to touch on our current legal construct and boundaries in order to have discharged my responsibilities as your trainer in this area. If we could advance the slide, please. All of you are familiar with the Plan 2 Governance RCW chapter. And I only mention it here because when we say follow the plan documents, this is the plan document. If we have questions that we need to answer about, you know, what is or isn't, which path to take, you know, this is just a reminder that this should be the first place for everyone to look. If we could advance the slide, please. At all times, in order to protect the integrity, which was one of those principles, you know, really this chapter, RCW Ethics in Public Service, is just, this is just another codification of really that principle of integrity, which has been with us forever. You know, gifts are not good. You know, avoid conflicts with employment or anything else. Refuse compensation for your duties. Don't use state resources for other means. You know, there's no news here, but just want to remind you of that this should always be a guide to all board members. Next slide, please, and staff for that matter. This is different, right? Public Records Act and the OPMA were not. These only came into being in the 1970s. These are an extraordinarily, you know, modern and new concept. The only thing that's maybe is maybe an underlying concept that is integrated into this is the idea of accounting and accountability, right? At the end of the day, if you look back to you know, the Middle Ages and that example I brought up, yes, the people managing the estate on behalf of the Crusader had to give an accounting. They had to provide information. And at the end of the day, the Public Records Act is really the modern mechanism to ensure that the people, the beneficiaries, the stakeholders, that they have the right to basically access all decision-making and all records associated with what we do, right? Current, you know, also modern day, obviously they didn't have emails, texts, IM, photos, social media, you know, just be mindful basically about what is a record and what isn't a record. We could advance the slide, please. Open Public Meetings Act. At its core, the purpose is to make sure that decision-making is taken in an open forum so that stakeholders can understand why decisions were made, and also make sure that the process is transparent and that there's nothing but the greatest integrity, right? And the really only cautionary notes that I'll throw in here is that it is possible to have accidental meetings. The reply all button is dangerous. Avoid it at all costs. One-way communications are one thing, but the second you do that amongst the whole board and discuss transact business with a collective intent to do so, you got yourselves a meeting and you have a violation for which you're personally liable. So just be very mindful of that. If we could advance the slide, please. Other resources. This is just a reminder that if at any point in time, any of you have any questions regarding the discharge of your duties, and or if there's something that you feel that you really need the counsel of others on, you not only do you have the ability, but also you have the duty to inquire of specialists, right? And there is no greater set of specialists than the LEF2 staff itself, whom you hire and monitor. I am your resource. I have made it a habit in the last couple of years at every live training to give you my business card with my cell phone number written on the back. For those board members who were at the last physical training, I hope you still have it. For the rest of you, I'll make sure to get it to you at the next meeting. Other state resources, clearly the actuary, the Department of Retirement Resource, or DRS, the State Investment Board. There's a host of other resources that are available and whom you do rely on a day-to-day basis. But also, to the extent that some of you may have your own staff or other resources, it's also perfectly permissible to consult with them if appropriate. Advance the slide, please. Finally, the best resource is your own judgment. And if you bring those principles of fiduciary duty to bear that I mentioned earlier, that are so well grounded in history, then the board will basically be in a great space for years to come. If we could advance the slide, please. So I covered all of those very quickly. If any of you have any specific questions, obviously I'd be more than delighted to respond to them. And I do appreciate the opportunity to do so. Thank you so much.
Are there any questions for Tor? Tor, would it be possible to use LEF2 funds to go on a field trip and visit some of those places that you described?
Today, you can do it virtually with a museum tour. One of my best resources was the British Museum site. So in reality, I'm not so sure.
I'm just kidding. All right. Any good questions for Tor? All right. Thank you, Tor.
Thank you for indulging me.
Mr. Nelson.
All right. Every 2 years, the board conducts elections for officers. And this is the time for those elections. Tim, if you could pull up the slide. These are the three positions that are up for election. Beginning with historically, you just do chairman, vice chairman, and then you select a third member of the administrative committee. The beginning with chair, then this would be the appropriate time for a motion to nominate anybody for the position of chair.
I make a motion to nominate Dennis Lawson for chair.
Second.
And then are there any other nominations? Hearing no other nominations, then it would be a time to vote for chair. All those in favor of Dennis as chair, signify by saying aye.
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 Are there any nays? Mr. Chair, you remain as chair, and I'll turn over the remainder of the voting to you.
All right, thank you, everybody. We'll go ahead and open up the nominations for vice chair. Are there any nominations for vice chair?
I would like to nominate Jason Graneman for vice chairman.
Second.
We have a motion or a nomination and a second for Jason as the vice chair. Are there any other nominations for vice chair? Hearing or seeing none. All those in favor of, I guess, supporting, voting for Jason, please say aye. Yes.
Aye.
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 Opposed? All right. Congratulations, Jason. Thank you. And our last position is the administrative committee representative, which is currently held by Ade. Is there a nomination for a administrative committee person? This is the employer group.
I'll make a nomination for Ade.
I'll second.
Okay, Steve, I know that the nomination is in order in second because he's currently on the board. Do we know status? I mean, I know he's in Nigeria right now. Is he planning on staying for a while? Is that the hope?
Ade has expressed his desire to remain on the board.
Okay.
And has conveyed that to the Association of Cities, and they will be reviewing how their position on that during this interim, and then once they've decided, that'll kind of lay the groundwork for whether he'll be continuing on the board or not. If his membership on the board terminates, then there could be a follow-up election at that time to elect a replacement.
Perfect. I just want to make sure he's willing if he's nominated. He sounds like he is.
Yeah, he told me personally he was.
Okay, great. Are there any other nominations for the position of employer representative from the administrative group? Hearing and seeing no other nominations. All those in favor of voting for Ade, please say aye.
Aye. Aye. Aye.
Opposed? All right. Mr. Chair, or Mr. Nelson, boss, that concludes our board officer elections.
All right. The next item up on the agenda is the administrative update. You guys have been, you've had a lot already, and we're a little bit behind schedule. So I'm going to be very brief and just mention a couple of things. I had an opportunity to speak recently to WACOX. That's the only stakeholder event that took place in the last month. I don't have anything scheduled for this upcoming month. And then the board conducts an annual audit of expenses. The state auditor's office will be doing that audit again, as they have the last couple of years. But this year, they will also be doing a performance audit. They'll be reporting to the board in November, and that's so their report will be a little bit different than it has been in the past. With that, I'd be happy to answer any questions that board members have about either of those two topics or anything related to the administration of the board.
Any questions for Steve? All right. Seeing none? Steve, I think we're gonna move on.
All right. Jacob is next up with 3 presentations. And so the first one has to do with a follow-up on a topic that the board has discussed several times over the past 3-4 years, dealing with interruptive military service credit and potential changes to the benefits provided in that area. And with that, I will turn it over to Jacob.
Hey, good afternoon. For the record, Jacob White, staff to the board. As Steve said, you're all very familiar with this issue. I think we've been talking about it most of the last 3 or 4 years, at least. But just as a reminder, the issue here is should eligibility for no-cost interruptive military service credit be expanded to those who earned campaign medals to also include those who earned expeditionary medals. So a reminder of what the board did with this issue last year. In 2020, the legislature required the Left 2 board and the Select Committee on Pension Policy to submit studies with recommendations on this issue. The board voted to defer making a recommendation until next year, or now this year, because of concerns regarding the cost of the benefit and the unknown revenue impacts from COVID-19. Also, since the proposal being considered would be retroactive, it did not seem that there'd be much harm to members to wait a year. However, the board did express support for the policy last year to expand. I'm getting feedback from, I think, Dennis.
Yeah, sorry. Working on it.
No problem. Okay. So I'm going to walk you back through the interpretive military service benefit, just as a reminder. A member qualifies for this benefit when they take a leave of absence from their position to serve in the military, and the member returns to their employer after their service is done. There are 2 types of benefits they can qualify for in this situation. The one at issue here is the fully subsidized benefit known as the no-cost interruptive military service credit. And then there is also, for those who don't qualify for that, there's partially subsidized service credit. So to receive no-cost service credit, a member must meet the definition of veteran, meaning they served during a period of war or earned a campaign badge or medal. I'm gonna go ahead and just skip by this slide. I think I've covered a bit of the legislative history. Just some high-level definitions of the medal categories to help understand the difference between campaign and expeditionary medals. There are other medals, but just want to focus on the 2 that are at issue here. So the campaign medal recognizes the highest level of personal risk and hardship for members who are deployed to the geographic areas where the combat is actually occurring. While the expeditionary medal is very similar, except not in the geographic area where the actual combat is occurring. Instead, they are awarded for those in support of those in the combat zone. So I want to provide more detail about the specifics of expanding eligibility. In particular, I have a couple examples on the last 2 bullet points here. As there's been questions that have come up over the last year or so regarding these situations, and I want to make sure it's clear how these would be handled based on the staff's understanding of the proposal and discussions with both DRS and the actuary's office. So the first example, a retired officer earned an expeditionary medal during interruptive military service. When retiring, they chose to purchase partially subsidized service credit for this interruptive military service. Under the proposal, the retiree would receive a refund for the payment they made, and they would continue to receive the same monthly pension payment, which had already included the interruptive military service credit. And then the second example is a retired firefighter earned an expeditionary medal during interruptive military service, except when retiring, they chose not to purchase the partially subsidized service credit. Under this proposal, the member would have their benefit recalculated prospectively to include the additional no-cost interruptive military service credit they are now eligible for. This member would not receive a retroactive payment adjusting their benefit from their retirement date. It would just be from the effective date of the bill moving forward. So that gets us to here. I have a screenshot from the 2020 actuarial fiscal note. So just won't go through the whole thing, but just to draw your attention to first that this is broken down by prospective and retroactive. And retroactive can be a little confusing when talking about this because there's a few, just as the previous example showed, there's a few different areas where retroactive can apply. But here for the fiscal note, retroactive is looking at medals and badges for service prior to the passage of the bill. And prospective is looking at medals and badges earned for service after passage of the bill. And we can see here that taken in total, it's about a 2 basis point increase for employees, members, and the 25-year cost is around $9.7 million. So here's where we get to something new. At the end of last year, we actually received a response to a FOIA request we had made with the Department of Defense. We'd made that request, I think it's been about 2 years now, but we did hear back, and we were able to share that data with the actuary's office. And they kind of took a look at their fiscal note from last year and started doing a new analysis based on this additional data. And they haven't provided us with a full fiscal note. They had just provided us with I think it was like an email or a letter with some initial analysis. And so here's just an explanation of what they provided us, how that FOIA request impacts their previous analysis that I shared on the last slide. And I should say that previous analysis, the data was mostly, they had a few data sources, but the main data source was data they'd got from the Department of Military. And so this just, the FOIA request helped supplement that data. So they found that the ratio of expeditionary to campaign medals could be lower than they previously expected, reducing the expected cost by approximately 25% for both prospective and retroactive. Also, it appears that the expeditionary medals were granted at a higher rate in the early 2000s than they had anticipated. OSA anticipates this could roughly double the retroactive cost from their previous estimate on the last slide. So when combined with the impact of bullet 1 above, OSA believes the overall retroactive cost could be around 50% larger than what was shown on the 2020 fiscal note. So OSA would need to do further analysis to provide the expected contribution rate impact. And so they prefer having an actual bill draft before they complete that analysis, but they were helpful in providing this initial analysis to us. So as a reminder, the 2020 legislation, which required the Left 2 board to study this issue, also required the select committee to study it for the other retirement systems. And so in 2020, the select committee also voted to defer making a recommendation. And this year they are planning on scheduling an initial briefing in October. And they would likely receive a second briefing in November. And then if they were to take action, that would most likely be in December. So the next steps here are that the board will receive a final briefing on this issue in November. Before that, the plan is for Left 2 board staff to draft a bill, provide that bill to the actuary's office so they can complete a full fiscal note for the board to consider in the November meeting. If there are any questions, I'd be happy to answer them. Thank you.
Are there any questions for Jacob? All right, we'll dive in, move forward into the next one then, Jacob. Jacob's been doing a series of presentations this interim dealing with using the benefit improvement account to pay for a benefit improvement. The benefit improvement he studied came out of a bill last session, and he's been kind of going over that bill and questions resulting from that in his previous presentations. And this is sort of the conclusion of the educational briefings related to that. And with that, I will turn it over to Jacob.
Okay, once again, for the record, Jacob White, staff to the board. So this is the 4th benefit improvement account educational briefing the board has received this year. Just want to give you a quick reminder about what the previous 3 presentations covered. So the first one was regarding benefit, the benefit improvement proposed as part of Senate Bill 5453, and that presentation included a presentation from the actuary's office on their fiscal note. The second presentation was on the mechanics and impact of using the Left 2 benefit improvement account to pay for a benefit improvement, and issues related to purchasing a benefit with the BIA when the BIA does not have enough money to fully pay for the benefit. And then third was the board's policy goals of purchasing a benefit improvement using the BIA. So during those previous briefings, there were a number of questions that were raised, and the purpose of today's briefing is to go over those questions and provide opportunity for input from the board, and for the board to provide direction to staff on how you would like to move forward on these issues. So I've categorized these questions into groups and tried to provide some pros and cons for you to consider. The first group of questions are regarding active member benefit, which we've discussed the mid-career multiplier as a benefit that was in the legislation that's been discussed. So the first issue is, should the demarcation date between qualifying for the lump sum versus qualifying for the increased multiplier be backdated prior to the passage of a bill, or be after the effective date of the bill? And so the pros of backdating it are that it would help limit members from making retirement decisions based on the possible benefit improvement. This would help employers from experiencing unexpected retirement decisions of a large group of employees. Could also help members from the stress and uncertainty of making a retirement decision based on a bill which may or may not pass. And then some possible cons to that are that it doesn't give members the opportunity to make a decision based on a bill that actually passes. They could wait and see which decision they believe would be better for them, either to try to qualify for the lump sum or to qualify for the increased multiplier. And I should add that the bill that was considered last year was backdated. So it was the date in the bill was February 1st, 2020. So the second question here is, should members who retire after the passage of the bill with less than 15 years of service receive a lump sum payment? And so the pro here is that it helps meet the policy goal of equity, since these members would have paid contribution rates, which included the benefit improvement, but they will not actually receive a benefit improvement. Possible cons would include it does not further the policy goal of retention. Many of these members would have been able to receive a benefit improvement if they had not left their left career and had continued to work. So I should have asked Steve how he wants me to do this, but do you want me to pause after each slide, or just if there's any questions, please feel free to ask them at any time.
Yeah.
Otherwise, I'll just keep going through.
Yeah, pause after each slide like you did, Jacob. That's, and then members, you're welcome to chime in anytime, but if you've got questions about either of these two issues, now would be a good time to kind of discuss them. The plan is to bring you back answers to these questions in next steps, if that's your will. But this may be the last chance to really kind of discuss these policy issues.
Okay, I'm gonna go ahead and.
Oh, Jason's got a question.
Okay.
Jason, go ahead.
Thanks, Steve. Good morning, Jacob. Hey, can you clarify number one for me a little bit? I'm sorry, I think my brain's lagging behind a little bit this morning. It's just that process isn't exactly clear to me. I just don't think I understood what you said the first time.
Yeah, no problem. So the issue here is that should a bill that has this benefit improvement, since there's going to be two separate benefit improvements, you have the one for people who are already retired, which would be a lump sum, versus those who are not retired would be able to qualify for the increased multiplier. And so there are a lot of people wanting to put off making a decision about their retirement out of the hopes of qualifying for one benefit over the other benefit. And so one way to just remove people making decisions based on that benefit improvement would be to just have the effective date of the bill backdated. It could be backdated to, you know, the date that was in this bill. It could use February 1, 2020. And that way people qualify for the lump sum or the increased multiplier based on their retirement status as of February 1st, 2020. And that way no one's, there's not a rush of people either retiring or people who had told their employer they were going to retire, deciding that they're going to hang on, work a few more months so that they can qualify for the increased multiplier instead of the lump sum benefit. And so I think there was just some concern that there could be unexpected changes to who's retiring and who's not retiring. And so that's something that could be dealt with by what effective date you have in the bill.
There was a question in the chat kind of related to this same point from Dallas Baker. And the best example of this for Jason and Dallas is, for instance, when this bill came up last session, you had a bunch of members trying to decide they had planned on retiring in March, or they planned perhaps on retiring in April, and now they didn't know whether they should go through with those plans or whether they should wait until after session to see whether the bill passed. Similarly, now you've had a lot of members dealing with that issue this interim. Should they go ahead and retire this interim as planned, or should they see if there is a bill next session and whether or not that bill gets passed? So that's the uncertainty that Jacob has described for both the employers and for the members that could be resolved by fixing a date. The original bill last session didn't have a fixed date in it, but there were discussions about that bill throughout the interim, and that was, or throughout session, and that was one of the questions that came up. The idea of February 1 of 2020, the bill was not introduced until after that point in time. So anybody who had made a retirement decision prior to February 1 of 2020 did so based on their own there was no possible consideration of this bill affecting their decision. But since that time, now this idea of a bill or potential legislation has come into play. And hopefully those Jacob's answer and this little bit of context answers all of those questions.
Yeah, definitely for me. Yeah, it makes sense that we're kind of doing a grandfather-ish type maneuver here.
All right, I'm not seeing any other questions.
Okay, I'm gonna go ahead and move on to the next one.
Before you do that, it took me a while to get to my little clicker here. But so what we're saying is that under number 1, the date that would be set would be 2020. Correct?
Yes.
If we start pushing it, it'll be 2020. So everybody knows 2020 is the date it starts. It's not going any retro further back than 2020.
February 1 of 2020.
Got it. Okay, I'm on. Got it. Thanks.
Okay, so the second group of questions is around retired member benefits, and this is the $20,000 lump sum benefit. And so the first question is, should retirees have an option to purchase an annuity with their lump sum payment? And so the pros of this would be that there's no expected additional cost to the plan, and it helps protect members from any possible from the possible tax consequences of receiving a large lump sum payment all at once. And so possible cons for this would be that there is an increased risk of cost to the plan, and this would occur if the actuarial assumptions are not met. So whenever this is no different than the risk to the plan of any annuity purchases allowed. But this would be an increased number of annuities purchased. So the second issue is, should the lump sum payment go to all employees regardless of years of service? And so the pros of this is that it could be seen as advancing the policy goal of equity, that it's more equitable since all retirees have paid into the benefit improvement account, even if they have not worked or do not have 15 years of service. The possible cons would be that this would cost more, and it doesn't align with the mid-career multiplier, which also would start at year 15. You'd have to have 15 years of service. So by kind of aligning both these benefits with those who've worked at least 15 years. So any questions on either of these two issues or any comments?
Jacob, apparently in my earlier answer to the question, I said February 1 of 2020. I meant 2021. I apologize for that. Are there any questions for Jacob related to the lump sum?
Okay, I'm going to move on to funding questions, the last category. And so there were concerns raised in previous presentations regarding the contribution rate increasing with the benefit improvement, even if there was enough money in the BIA to purchase that benefit. And this was because of the board's current funding policy, or at least in part because of the board's current funding policy. The benefit improvement would cause the normal cost of the plan to increase, which generally increases rates under the board's funding policy, even if the BIA has the money to purchase the benefit improvement. And so the question here is, does the board want to receive options from the actuaries on the potential issues regarding the intent of the BIA to pre-fund a benefit and the board's current funding policy?
Hi, Jacob. This is Mark Johnston.
Hi.
With respect to that, it's my opinion as a board member that we should get some options from OSA on that question, because I think it's important to be able to have a very transparent policy, and we need to know as much as possible about what the costs are going to be and how that aligns with the funding policy. That's my opinion for the board members.
Okay. Don't see anyone else. Oh. Okay.
Jason?
Yeah, I would agree with Mark. I think it, part of our fiduciary responsibility is incumbent on us to request that information from OSA.
Yeah, historically, the board has talked about funding policies as part of your strategic planning. And so the idea would be to talk about the funding policy and in October, your current funding policies. And given the earlier presentations by Matt and Mitch about economic assumptions, I think this would roll all into that. And so I would expect that, well, I would plan on discussing funding policies and including how the benefit improvement could impact those at your October strategic planning meeting. And then Senator Holy has a question.
Oh, thank you, Mr. Chair. Steve, I guess I'm wondering about narrowing the scope of our request for OSA. Would it be appropriate to have the board come back with some proposals or options to accomplish this, and use that to present to OSA so they have very specific criteria to analyze rather than just asking for a general policy statement?
Yeah, I think the discussion, because the investment returns from the past year, that the effect on that of the funding of the plan has become very intertwined with the discussion regarding adoption of the recommended changes to the long-term economic assumptions. And with respect to LEF 2, I think those two issues now are going to be intertwined with how does benefit improvement affect, or how is a benefit improvement affected by these other changes? And so I think a kind of a discussion about all three of those issues, how they all play in, and some of the potential options that the board could consider. We could do that in October so that you could then provide a little bit more direction to OSA in the November, December timeframe. Does that sound reasonable?
Well, absolutely. I'm just trying to figure out the most efficient way to get to an action point here.
Okay, I'm going to go ahead and move on to next steps. So is there consensus on how the board would like to address any of these issues discussed today, or how the board would like to move forward, which Steve has just talked about a bit? And then if not, does the board want staff to bring back additional information on the remaining questions for the November meeting? So really just how would the board like to proceed moving forward into the November meeting?
So this is Mark Johnston again. I'd like to make a motion. Is that in order, Mr. Chair? So I'm asking the chair, is it
Mark, can you hear me, Mark? I'm sorry.
Yes, I can now, yeah.
Okay, go ahead, please. Yeah, your motion's in order. Go ahead.
Okay. So I'd like to move to direct the board staff to continue their work and bring back options associated with the benefit improvement account bill for the next legislative session.
I'll second that. That meets my criteria too.
All right, great. So we do have a motion made and seconded. And I'll paraphrase, basically directing the staff, the team to continue their work and bring stuff back to us in the future for our November meeting. Is that correct, Mark?
Yes, Chair, Mr. Chair, that meets the intent of my motion.
Got it. All right. Is there discussion on the motion? Not hearing any discussion, although I do know that there's been a conversation had regarding that lump sum amount. I assume that when the staff is looking at the totality of this bill, what it looks like, you'll have options associated with the lump sum. Is that correct, Steve? I can only assume some of that would be taking place.
Yeah, we haven't got any direction from the board as far as any specific options that you would like to have presented in November, but we could come up with some on our own and bring those to you in November.
I think we would grant you that latitude to explore options. I think that would fall inside that area.
Yeah.
Is there other discussions?
Jason?
Yes, piggyback on what Dennis was saying. We had discussions early on in that original bill. There was that $20,000 number. And so there were many discussions on, where that came from, how that was decided upon, like where did 20,000 come from? Is it economically feasible? Is it a reasonable amount? Is it something we can do? Can we do more? A lot of discussions upon that. So it'd be great to have some type of information to base what a payout would look like in that lump sum amount, other than just, hey, somebody picked a number.
Thanks, Jason. Other discussion?
Yeah, so Mr. Chair, this is Mark Johnston again. I would just have a comment on the last issue that Jason was talking about. I wouldn't mind hearing some or getting a little bit more information about a possible graduated lump sum payment for retirees depending upon their years of service in the plan.
Okay. I think we can work with the team, the left board, and as far as the left team there with Steve and his team to go ahead and figure out how we can make this very broad, bring back more options, more information. Other discussion, other comments? I'm not hearing any. Steve, are you seeing anything?
No, I'm not seeing any
chat. Okay. All right. For the board, all those in favor supporting the motion as made and seconded, go ahead and say aye.
Aye. Aye.
Aye.
Those opposed? All right, Steve, not hearing any. We'll go ahead and move forward. Thank you. Thanks, Jacob, for that one. I think you're going to move on one more, right?
Yes, one more.
All right. No, that's good. Thanks. Okay.
Chair, before we move on, is there going to be any more voting, or is that it? Ms. McElligott.
That's the last action item for today, Pat.
Okay, because I'm going to have to sign off unless you need me. I'll have my phone with me if you need me to come back.
Okay, I'm going to go ahead and start up on the my last presentation of the day. So this is an update on the private letter ruling from the IRS that I spoke to you about a couple months ago. So as a reminder, the issue here is allowing members to change their survivor option election after retirement may raise plan qualification issues with the IRS. The Left 2 board endorsed legislation to allow Left 2 retirees up to 90 days after the receipt of their first retirement check to prospectively change their survivor election. The bill was amended during session to include all DRS plans. During session, DRS asked their tax counsel, which is also our tax counsel, Ice Miller, to review the bill. And Ice Miller identified possible plan qualification issues with the bill. The bill was then amended to not take effect until the state received determination from the IRS that the bill would not, or that the bill would conform to federal law and not jeopardize the plan qualification status. The amended bill passed and was signed into law. So since then, the Left 2 board has been working with DRS and Ice Miller to request a private letter ruling from the IRS. Ice Miller drafted and submitted the request for a private letter ruling, and they've been in contact with IRS. And the request was for one private letter ruling for all the systems and plans. That was otherwise it costs money for each system and plan. And that request was filed in February 2021. So at a board meeting earlier this year, tax counsel had asked the board whether you wanted to try amending the law to apply retroactively, because as they had been in communication with the IRS, they believed the policy had a greater chance of being approved if it applied retroactively. And so they wanted to know if the board wanted to do that, or to try amending the bill, or not the bill at this point, try amending the law, or if the board wanted to move forward with the PLR and see what the results of that were. The board decided to move forward with waiting until there was a decision from the IRS. And so drum roll, it was a good decision from the board to wait till we heard back from the IRS. So the IRS ruled in our favor that the Senate Bill 6417 does conform with federal law and that it does not jeopardize the plan qualification. And so we've been working with DRS on the next steps of actually implementing the law. DRS is planning on processing requests manually while they work to update their computer systems and their internal processes. They have assigned a project team to it that's working on this, and their first priority is to focus on updating their WACs, their rules, and they're including Left 2 staff on these updates, on reviewing their drafts of those updated WACs. And so did just want to share with you some initial decisions that DRS has made in terms of processing any request. So the law is effective August 3rd, 2021, which was the date that DRS received the PLR ruling. And so the law was pretty clear that that needed to be the effective date. There's a 90-day, the 90-day window will begin when DRS issues a payment. This is typically the last business day of the month. And then DRS was going to leave that window, the 90-day window, open for members who have retired prior to the effective date, but that were still, it had been less than 90 days since the effective date of their retirement, or since their retirement, receiving their first retirement check. And then also they'd made the decision that they were going to limit members to only making one change during the 90-day window, that someone could not try to change their survivor option multiple times within that 90-day window. And then I guess it's been a few weeks now. A few weeks ago, DRS did file the CR 101, which is the first step in the process of updating a WAC, as far as notifying the public that they're planning on updating these WACs. And then I did just check in with the staff at DRS yesterday, and so far they have not received any request from any of the plans, any members of any of the plans to change their survivor option.
There were a couple of requests that had come in while DRS was waiting for the private letter ruling. And DRS has decided that they will not honor those requests. So that's one issue. As far as we've been able to determine, those requests did not come from left two members. But I'd be happy to answer any questions you have about those.
I guess I have a question, maybe somewhat related. A lot of times from the presentations we've been hearing over the years, the adjustments or the change in benefit might not be figured out until an audit a couple of years after that person was retired. And we were looking at, giving people the option, should there have been a significant change in someone's retirement benefit, that might be an allowable opportunity for them to choose a different selection based on that. Are we any further on that right now?
No, unfortunately, Representative Bergquist, the analysis that was done on this issue, they kept it very specific. So that idea of a window to correct an error, or a window when there's been, for reasons other than an error, a significant change in the person's benefit, that issue is still open.
I will add that it's something I could follow up with DRS. I know they have standing meetings with ICE Miller, and so I don't think that's something that ICE Miller talked to the IRS about. But I wonder, I would be curious what what ICE Miller's take on that would be, if that's something. I think they were aware that it's something we were considering. So I will kind of check with DRS and try to check with ICE Miller and see, if they have any kind of gauge on where they think the IRS would come down on that.
That'd be great. Thank you.
Okay, so that completes the last presentation, unless there's any additional questions.
Are there any additional questions for Jacob? Can you hear me, Jacob?
Yes.
Okay, thank you. Sorry. I switched to my phone, so. Any other questions? Not hearing any. Steve, anything else?
No, the next board meeting is October 27th. That meeting will be remote again, so it'll be by Zoom and by phone. The meeting will be more strategic in nature. We won't be planning on bringing you action items, but rather seeking your input and discussion on some of the broader issues affecting the plan. We'll have that agenda out to you as quickly as possible.
Okay, and then also as we start to forecast for November and December, we've got a few things coming back to us, a few action items that we've requested, and we'll need to, highly likely we'll need to take action if we're going to do anything for a board no later in our December meeting. Is that correct?
Yes.
Okay. All right. Sounds good. Anything else for the group before we leave?
No, nothing from me.
Okay. All right. Well, we'll go ahead and I'll entertain a motion to adjourn.
So moved.
So moved.
Second.
All right.
Third.
Motion's been made and seconded. Motion's been made second and third to adjourn. Anybody wants to stay on, and Tor's going to give another great report for me. So I like history too. All right. All those who want to leave. Me and Tor are staying on.